Good morning, everyone. 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Diane King Hall here this morning. And here are the 3 things that you need to know to start off your day. Sometimes a beat is all you need. Target shares rocketing despite weakening sales. The nation's second biggest retailer seeing EPS blow past the street at $1.80. The road ahead not quite as bright. It cut its full year forecast for the top and bottom lines amid a struggle to convince shoppers to go for bigger ticket items. CEO Brian Cornell highlighted the improving picture on inventory, but warned over rising rates and the return of student loan payments as future headwinds. Number 2, China, still very much front and center here, of course, amid a darkening economic outlook. The nation's central bank injecting the most short-term liquidity since February, a day after cutting rates in a surprise move. It doesn't stop there. The on-share yuan slumping to 16-year lows against the dollar and new home prices dropping for a second month. Now, Bloomberg reporting authorities are asking some funds to avoid being net sellers of equities in a bid to stem declines. And Fed minutes are always crucial, but today is coming at a pivotal point for investors. A mixed picture on data and some warning signs in corporate results mean any sign of hawkishness will be watched with laser focus. All that as Minneapolis Fed President Neil Kashkari says that the central bank has made some progress, but inflation is still too high. September's meeting is already front of mind. Last week, the San Francisco Fed's Mary Daly told Yahoo Finance she's looking at all the information, not just data.
All right, shares of Target seeing a big boost in the pre-market today. This after a strong beat on EPS that offset those weaker than expected sales in the second quarter. CEO Brian Cornell noting the company saw better than expected profitability despite sagging sales. But the company reiterated a cautious outlook for the year ahead, lowering its full year guidance in anticipation of, quote, near-term challenges from current trends. Yahoo Finance's own executive editor Brian Sozzi joins us now to discuss. So yeah, Brian, one of the things that stood out to me was that caution over sales and the forecast there.
Only in Bizarro retail analysis or Wall Street analysis do you get the market reaction we're seeing with Target here today. First, you have a company coming out here lowering the bottom end of their guidance by 75 cents, taking down the top of the end of their guidance by 75 cents, and the stock price is up. Why is the stock price up? Twofold. One, you now have analysts already, some of the notes I've seen coming into my box, already looking for guidance for 2024, and maybe you see a sales recovery next year. Look, I get it. This is how Wall Street thinks. And then number 2, across the same lines of this crazy Wall Street thinking, that the guidance cut, even though it was cut by 75 cents, wasn't as bad as feared. Okay. I get it. But I was on a call with Brian Cornell, the CEO of Target, and the CFO of Target, Michael Fidelki. I heard the caution in their tone. I think they're concerned about how the back-to-school shopping season is shaping up. Cornell said it started solid, but that really rings hollow to me when you see a company really come out here and issue third quarter guidance that is well below consensus estimates and telling you that consumers are fearful about spending as student loan repayments resurface and because of higher gas prices, whatever it is. This was not a good quarter for Target. I understand why the market's rallying here, why that market for Target shares are rallying, but that's a tough sell after the numbers I'm seeing on this company.
It is. I mean, and that's the thing that stood out to me, like the caution when you have an executive, because they usually try to kind of paint a robust picture, especially when they're on their earnings call. But to issue that concern, especially when you're coming into kind of the year end, these are big seasons for retailers. When you're talking about back to school, then heading into the holiday shopping season, it should be a boon for retailers. But you have one like Target, which, you know, in some respect, it's not necessarily the high-end consumer, but it reflects a consumer who is striking a more cautious tone, and it flies in the face of the things that we've heard about the strength and resilience of the consumer.
Yeah, and a few things that, you know, when we were looking at the stock price reaction, my mind jumped to are investors thinking that there's a bottom set in, at least in some of those discretionary categories that they called light to as well in this report this morning.
Yeah. My first read, I hear what you're saying. My first read off of this was, wow, when Walmart reports earnings tomorrow, they are probably going to beat on earnings and maybe issue inline guidance, and the stock could react favorably. This is a company in Walmart that has come out the past 6 months, become more aggressive on price points. I think that's impacting Target. But what Walmart has seen, they are gaining that higher income shopper.
Yep. Right.
That income shopper, and $100,000 in an inflationary environment we've been dealing with the past 2 years, and you have 2 kids, that is not high income. No. I know this, it says 100,000, but that doesn't mean you're loaded, and you're looking for deals just like the next person out there. And I think they're finding those deals and a better assortment at Walmart. Now, having said all that, Target, best-in-class retailer, I think they will get their act together, but they need the economy to start to show that it is getting this act together.
They did have one bright spot, beauty. That was a bright spot. Sorry, I had to. I mean, did. It was.
Look, and groceries were a bright spot too, but for Target stock to work, you have to see home goods doing well. You have to see discretionary departments doing well, because when that happens, margins go up, their profits go up, and analysts raise their ratings and their price targets on the stock.
Or they have to lean into the grocery play, which they've been doing a little bit more of.
I get all my groceries at Target. I like Target.
I do not get all my groceries at Target. I'm sorry.
Go down there.
So I'm not a big fan of Walmart, but if I'm doing groceries, I'd rather go there because they have a bigger assortment.
I just got some great fish at Target. I got to give them a shout out. Fish, fresh salmon at Target. I'm all about it. $12 a pop. Sign me up. Oh, it's fresh.
No.
We're going to get a picture.
You're tossing that thing like the pipe
out today,
market.
New York, Bayshore Target. Shout out to my friends there. I'm going to take a picture of that fresh salmon for you.
We're going to switch to the discounters.
Let's swim to TJ Maxx.
We're going to swim to the discounters. Speaking of discounters, TJX also reporting this morning with strong earnings. That's sending that stock up in the pre-market. Same store sales jumped 6%, beating expectations. That's thanks to strong customer traffic. Parent company of TJ Maxx, Marshall's, Home Goods raising its full year guidance. And you also even saw Home Goods do better. And I know that was something that we were looking at. And it shows that the consumer is starting to be more discretionary with how they spend their money. It reminds me of the Great Recession, where you even saw the high-end, well-heeled customer going to TJ Maxx. And we're proud of it.
Well, I'll write the stories there for my former retail beat reporters. 3 stocks will win as consumers trade down, and that is TJ Maxx, because they came out here with a same-store sales increase of 8%. At that key Marmaxx division. That is Marshall's combined with TJ Maxx. This company is delivering incredible value. They've gotten a lot of great inventory in the stores over the past year because of all the excess inventory from Target, Macy's, all these department stores. So the inventory looks good. Consumers are trading down. And look, bottom line, last week when I went into Home Goods, I found some great crystal whiskey cups for about $15. I left very happy, and I think there's a lot of people like me out there.
They always make a great white elephant gift, by the way, and it's not too early to stock up on those.
Soft pillows too, Brad.
Yes.
I mean, $10 a pop for like brand name soft pillows for my couch. I mean, how can you not get excited about that?
It's solid pillows, but at the same time, you got to. I mean, the inventory here is really the story, because at a time where everybody else is going through their own inventory management, it absolutely behooves TJX companies to really lean into where they can get some of that excess that's already produced, but some of the other major retailers are not going to buy into because they've already ran into quarters past of trying to work through that inventory and then having to take more promotions and execute those just to get some of the excess out of the stores as well here.
Yeah, I also like TJ Maxx. I also like the company's guidance. I think you're seeing this is going to be the back-to-school shopping season of value, and the stocks that are going to work higher, it's them. It's a TJ Maxx, it's a Walmart, it's even a Costco, I think.
All right, I'm going to still go back to that Target story that you were talking about too. Eventually,
not for fish. No, absolutely not, Brian.
I don't know what Target.
Olive oil, a little butter.
I highly doubt that they're tossing the fish like Pike Place Market.
Listen, literally got it on my lake in Babylon. I assure you that it's good.
I'll take the LIRR out there. Brian Sozzi, thanks so much for joining us this morning. So lots to digest. Target catching the attention now, but this afternoon the focus turns back to the Federal Reserve and some crucial minutes from the last meeting. Minneapolis Fed President Neil Kashkari says that the central bank has made some progress, but inflation still too high. Last week, San Francisco's Mary Daly told Yahoo Finance that she's looking at all the information and not just data. Let's see what our guest host today is looking at. Katie Kaminsky, Alpha Simplex's Chief Research Strategist and Portfolio Manager, here live in living color. Thanks for joining us in studio this morning.
Thanks for having me.
Absolutely. So let's start with the Fed as we kind of teed up there and off of some of the inflation data that's really kind of told this picture about the consumer right now. Perhaps we start on that. From the Fed's mindset, what do you believe they're saying is the state of the consumer?
Well, I think they think the consumer is doing pretty well. I mean, look at the data this week. I think that's why the market was so upset about retail sales. Right. When it becomes good news is bad news, it means that the focus of the market is on the bond market. It's focusing on rates and whether or not rates are going to move. We've been really focused on the long end of the curve. Take a quick look at the 10-year. Look at the 1-year horizon. What you're going to see is that we're on a steady movement upwards, particularly in yields on the long end of the curve. And we're fixing to get close to breaking out to a new trend in fixed income like we saw last year. And this to me indicates that the market is much more focused on, wait a minute, this data is not going to give us smooth sailing into the end of the year with no chance of another hike and also a chance of a cut.
When you say no chance of another hike, so what does the data tell you about, I know there's been a lot of focus on the inverted yield curve. At the same time, you have analysts dropping calls for a recession this year. What do you make of that? Is that something that could actually happen? Could we potentially sidestep a recession with where the yield curve is?
I think that's been the biggest conundrum this year. You've seen this inverted yield curve, which historically tells you recession. So everyone said, okay, the bond curve is telling us recession. But what I think is happening is there's a dislocation between expectations on rates. What's happening is, look at the short-term rates. I mean, I know most of you looking at buying, putting money in a money market, you're like, yes, 5+%. That's awesome.
That's nice.
I know, but then look at the long end of the curve. Who wants to buy a 10-year at 4% or 4.2? So those bonds seem to be either mispriced or there has to be a recession or we have to have a quick normalization. And for me, what has to happen is people need to realize that higher inflation for longer means that long-term debt has to reprice. Once I see that, then I think we can start talking about recession because we need to really understand what the effects of long-term changes in value over really long terms does to the equity market. And until we see that, I think we're kind of waiting to figure out what happens to the yield curve before we figure out where recession could occur or which sectors will be the most challenged in this new environment.
If we are able to sidestep recession, is there any need then for the Fed to cut rates, if some have brought up as well in early 24?
Precisely. That's the challenge, right? I mean, if we're seeing a floor because the consumer's okay on yields, and we're seeing a cap because the inflation is coming down, it means we're in the middle. It means that we're going to have inflation for longer. Inflation for longer means longer term cash flows discounted.
But does it get back towards their target at the same time? 2% target is what the Fed has set forth. Do we actually reach that target even if we do sidestep a recession and we're in that inflation for longer? But at what rate do we eventually see that start to trickle lower or trend lower, just as we've seen that lock in over the longer term at this point?
Well, I think we're going to need to see the yield curve move. And what I'm worried about is that it's going to be a realization, that it's not going to be a slow churn upwards, that people one day are just going to say, oh, long-term bonds aren't any good. Kind of like what happened in the banking crisis. That's what worries me, is that after the fact, it's obvious. But before it happens, I mean, you think to yourself, geez, why didn't I buy treasuries?
Yeah.
So that's what I think I'm looking for, is that equities look good. They're not the center of what I'm thinking about. It's really what happens to monetary policy and how does that affect cash flows?
To your point, yeah, I mean, it goes to that point about hindsight being 20/20, and often, even with the recession, but not often, with the recession, we don't know till we're in it.
Yeah, exactly.
And after the fact, I want to go back to the point that you made about the consumer being okay with yields. Is that really what you see? And are you concerned about the consumer inflation has come down, still elevated, but are you concerned?
Well, let's take a couple of pros and cons, right? So the pros are inflation seems to be going down. So prices are coming back to normal levels. On the negative side, savings are down, so there's less disposable income, like you guys were talking about. But if prices can normalize and the consumer can navigate some of this, you definitely can see a situation where the consumer is healthy enough, particularly in the U.S. versus other economies, to waver the storm.
Is there anything that could come out in the Fed meeting minutes today that take the markets by storm, that is a surprise that we see come across and gets factored in and priced in at 2 p.m.?
Well, I think the market's down because it's looking for that, right? It's saying, they're probably going to come in and say, just be cautious. This, this isn't over yet. And then I think that's what's priced in already going into this move. Now, the surprise would be if they came out and said, everything's great. We're never going to cut rates. we're going to cut rates soon. I mean, I think that's the surprise.
If they had said that during the meeting, yeah.
I think that's highly unlikely.
All right, well, we will watch that. Stay with us, Katie Kaminsky. The trouble in China continues. New home prices in the world's second largest economy fell in July for the second month in a row, adding to concerns. A growing property crisis will further slam a struggling economy. At the eye of the storm is troubled developer Country Garden, which missed bond payments this month. And now, according to Bloomberg, another company could be approaching default. It's an investment trust with large exposure to real estate, missed payments on dozens of investment products, and has no immediate plan to make clients whole. With the yuan on the verge of falling to its weakest level since 2007, the People's Bank of China stepped in to inject the largest amount of short-term cash since February. Officials now reportedly asking some investment funds to avoid being net sellers of equities in order to address the slide in the market. That's according to Bloomberg News. We're bringing back in Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager, for thoughts. So this is the latest shoe to drop now with China, and with all of what's happening there. Are we concerned enough? We saw the market reaction yesterday to the latest with regard to a faltering economy. Is the market assessing this correctly?
I would have to say yes. I mean, we have seen very negative technical signals on China versus the U.S. most of this year. It's definitely been a laggard. I think people were optimistic, but you're seeing this across the board in multiple asset classes as well. It's been a headwind for the oil market. So oil was supposed to come back. So that may actually be good for the consumer, for example. So there's some externalities there that we have to think about as well, is that may hold some of the inflation sensitive assets actually lower. So that's a positive for our economy in the sense that prices may be a little bit lower. But in general, we've seen that China has been lagging as well as the yuan.
Mm-hmm. For growth forecasts that have missed expectations this far, and for economic data out of China that has come in below what would signal a full-on rebound, how does that overflow into other parts of the world, other economies that also do business with China?
Well, I mean, I think it's definitely a key. It's one of the biggest business partners out there. So obviously it's going to affect overall growth, sales. I mentioned oil as the easy way to measure that already. I mean, if you looked at oil, it was on a tear. Everyone was talking about how it's making a comeback. And this data has really, in this week, really kind of dampened a little bit of that fervor because oil prices are saying, wait a minute, there's not going to be as much demand out of China. Thus, the picture is not as clear as we thought of this second cycle of commodities. And I think it's just, we're all interconnected. So that's going to affect us in the sense that sales and demand can be impacted.
Is there a contagion worry then?
Not as of yet. I mean, look at what's happened already this year. I mean, you could say that story has already been kind of going on all year, and the U.S. has moved very differently. And I think the thing that's been the most interesting this year to me is just seeing how dislocated different economies are in an inflationary environment. You don't see this sort of rising tide where everybody's doing the same. It seems very much like Australia's on a different frequency, China's on a different frequency, US, even Europe. And that's something that we haven't seen as much in a lower interest rate and low inflation environment. It was much more global in terms of those trends.
And so with the mindset that there's always a buying opportunity somewhere, in the weakness that's taking place in China, is there a buying opportunity for investors that are looking across some of the weakness that's been displayed and trying to figure out how they can position their portfolio?
I mean, I think the key point here is how much is priced in. And the challenge with China always is how good is the data? Sure. And if you really feel that all of the weakness is already priced in, then it might be a good buy time. But the challenge there is that data really all there? Or is there more data that we need to worry about coming in the next month or two that might make you skeptical of whether or not it's really yet the time to buy for a dip going to recovery?
And I mean, we will continue to watch the China story. Stay with us, Katie Kaminsky. Now to the commodities trade, which has definitely seen some inflows in recent weeks. Oil prices, chief among them, though they've seen a pullback of late, now sitting around $80 a barrel after a 7-week rally. The pressure comes amid that string of disappointing growth data in China. Katie Kaminsky is still with us to do a deep dive on oil. You did mention a little bit about oil prices, and we saw what had happened as a result. We saw this risk-off trade trade with the latest China data. Is there now a question of demand destruction in play because of this?
So I would say that if you look at OPEC and the suppliers of oil, they're really focusing on trying to limit supply and get oil prices up for business. On the other hand, in recent period, you saw a stronger dollar, which was a headwind against their goal. And then now you're seeing this data from China. And so if you looked at that graph of oil, what did you see? You saw a massive breakout. And then you saw it petering out a little bit. And so I think what we have to do is watch the consumer, watch the strength of the dollar, because that's going to really be a headwind if it continues to recover. And third, if the China story continues, it's demand destruction going against the goal for having higher oil prices from suppliers.
So is crude oil ripe for a breakout at this point?
We had been really watching a positive trend. There had been a very strong technical signal on the upside for oil. You'd seen a really massive recovery, and it looked like, and most people were talking about, okay, it's the next leg up since 2022. And I was interested in this because oil is the first thing to watch when you think about inflation, because it's usually those raw materials that start the wave. And then after that starts, it kind of trickles into the rest of the economy. So that was a very interesting move for me. But then there was these headwinds with the dollar and also just the China story that kind of murkied the waters of whether or not we're really going to see that uptick.
Do you have concern about the elasticity of the consumer when it comes to oil?
Well, certainly. I mean, think about oil as such an important commodity for the U.S. I mean, it's something that is an input to so many different processes. It's a bottom line item for a lot of commuters. So it is really something, if you're thinking about next wave of surprise and inflation, it's a good place to start looking.
And so additionally here, I mean, for the consumer that has looked across what they're paying for gas over the most recent years and known how much that's taken out of their pocket, it's been an additional kind of measure of the inflation that they feel in that pain at the pump, as the administration had put it many times over. All that considered, does the consumer feel any better now as a result of oil or gas prices being lower at this point?
I would say yes. I mean, anything that sort of alleviates some of the high costs that the consumer has taken on since last year, I think is a pro. That's why we were concerned about oil prices going up, because that could be sort of a catalyst into another wave. Because unfortunately, inflation doesn't just go away. It kind of goes in waves and it moves around. It's moving, and I was worried it was moving into oil.
Sure.
And speaking of catalysts, so one of the earlier predictions had been that demand from China would be a catalyst for crude. Is there still the potential for that demand to return or pick up from China?
Certainly, and I think if you look at oil prices earlier this year, they were pretty depressed and there was little movement. And I think a lot of that came from because you also had a weaker dollar, so you would have thought that would have helped, but came from that China demand, just not realizing.
And then just additionally here, Mizuho had been one of the upgrades that came through this morning on Chevron here. As we think about some of the oil and gas players that have been beneficiaries, at least over the course of 2022, and now during 2023, still watching closely to see where there are additional inflows even after the year that was. You still have some firms that are saying that there's a benefit even though oil mix has trended below long-term 50%, as talked about on their earnings call. What are some of the catalysts that could still move the oil and gas companies higher at this point?
Well, I mean, I think demand is obviously the first one. So we get demand back, particularly in China. If we continue to have a weaker dollar that positions oil prices and our relative export prices competitively. So those are the first two things I would think about. And of course, how strong the consumer is in terms of general demand.
All right. Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager. Great to have you here with us in studio today.
Thanks.
Absolutely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
So this morning we got better than estimated economic data. Stocks are down. Are we sort of back in that environment where better or hotter data is going to be bad for equities?
I think we shouldn't, I don't like the narrative around good is good or good is bad. I think we have to look at what the market has done, the totality of the moves this year, this last couple of months, where equity markets have had a tremendous run. And we need to come to terms with the fact that if we are now going to be in a higher for longer environment, that will have some ramifications on discounting mechanism, discounting rates of equities. So I don't want to point it to, good data is now bad for equity markets. I would just say that we need to think about valuations a little bit.
Shares of Target getting a boost this morning after a strong beat from EPS that offset weaker than expected sales in its second quarter. Heading into the fall, the company said it's gearing up for the biggest seasons of the year, but in the face of near-term challenges, Target lowered its EPS guidance for the full year. Joining us now is Corey Tarlow, Jefferies Vice President for Equity Research. Corey, thanks so much for joining us today. Let's dive right into these results from Target. To me, the market reaction, Wall Street reaction, a little unexpected, but what is your takeaway?
Great. Good morning, and thank you for having me. So I'd say that there's three key points to highlight here. Number one is on comp, number two is on margin, and number three is on the outlook. So firstly, on the same-store sales metric, or comp. So comp came in at around down mid-single digits. That was below consensus of down low single digits, and it was mostly traffic driven. I think the good news here is that we did see some better momentum in consumables categories like food and beverage, or even beauty and essentials. So that shift from wants to needs is in full effect at Target at present. The second, on margins were actually significantly better than what we saw last year, and also what we expected. This is predominantly driven by better inventory positioning. So inventories were down 17%, down 25% in discretionary categories. The markdowns were significantly lower than last year, and you also saw massively lower freight costs. And then thirdly, on the outlook was obviously lowered, as you pointed out, but the good news here is I think a lot of this was expected. So they're expecting now a mid-single digit same-store sales decline for the remainder of this year. That's relatively consistent with what we saw in the second quarter. So it feels like that's a relatively achievable bar, especially with the earnings guidance now lowered about 10% from the prior threshold.
I'm going to really piss off a lot of students out there, Corey, but I'm going to mention it. Back to school. What do these results say about how back to school season has gone, is going, or still will go when some of the K through 12 students head back into the classrooms and some of those very uncomfortable chairs?
Sure. Well, what I would say is that the back to school season thus far has illustrated some promising early reads. But again, it is still very early. We only have about a few weeks of spending data that we can reference. But the data so far does look promising. We've seen some surveys from and estimates from the NRF and other retail organizations and other consulting firms that all point to sales estimates being up for the overall retail sales during that period to be up about, call it low double digits. Of which Target is likely to command a significant share of that. So it is something that I would presume to think is a catalyst for the company ahead.
So, Corey, one of the things that execs express caution around is the return of student loan payments and what that could do to consumer dollars. What is your expectation with regard to the impact there to Target? Are they guiding enough to, take into account the potential impact from that?
It's a great question, and it's certainly going to be a headwind, and probably a headwind that's more acutely felt among the Target consumer than, say, a consumer that shops at the dollar stores. So the Target customer is probably slightly more affluent than a dollar store customer. Target customer probably has a college education and may have loans as well. And we did an analysis that actually looked at the percentage of customers that Target, Walmart, dollar stores, Costco, BJ's, and what we found is that the Target customer is actually one that could be more impacted versus some of the other retailers that we cover heading into this season.
So are the forecasts then as accurate as they could or should be, considering all of that?
Well, I think that what it just means is that there could be some near-term risk. And as you heard on the call today, that just concluded about a half hour ago, and this was highlighted multiple times by the management team as something that they are being cognizant of. So it does seem like this is something that they are taking into account with the new guidance that's been set.
Corey, we'd love to get a vibe check of those that have been able to listen in on these earnings calls, which sometimes they're very bland, they're very boring to listen into, but there's some nuggets that can be pulled out, and you can kind of catch the tone and tenor of what the executives are that are managing through this period. What is the vibe check that you would give to the Target leadership and Brian Cornell and team and squad?
I'd say that it's one of cautious optimism. I think that the consumer has been, while relatively resilient, there are some factors that are certainly weighing into the caution that the Target management team needs to keep into account as they think about the results ahead. We talked about student loans. Obviously, earlier in the year, we saw lower tax refunds. We've seen lower SNAP payments and all these other headwinds that the consumers faced. So I think that all of these things have had to be contemplated in the tone of the Target customer. Nonetheless, we have seen some slightly promising results thus far into back to school, although it's still early. So like I said, I think it's cautious optimism. There's still a bumpy road ahead. But as we do think about the trajectory for Target, we do think that, and this is really core to our thesis, that the margins should be better over time from about 5% this past quarter to 6% over time and potentially even 7%, which would be consistent with their historical average. So, and again, they're targeting 6% by the end of next year. So we do think that that is achievable. It will be a bit of a bumpy road to get there, especially on the worse than expected sales declines that we witnessed. But nonetheless, we do think that a certain element of caution has definitely been embedded into the tone of Target's management team, which I believe to be prudent.
And Corey, I want to really quickly get your take as well on TJX. They also put out their results today, better than expected. What's your takeaway on TJX and how well they navigate through the balance of the year?
Well, it's one business that does tend to do very well when a consumer is a little bit stretched. And it's a company that offers great affordability on name brand products. And they've seen remarkable momentum in not only apparel and accessories, which has been a key tenet to kind of our thesis as we think about the trajectory for this business, as apparel is a very significant portion of the overall sales. But we've seen a little bit of a turnaround in the home business here, and that business has lagged for quite some time following the COVID bump that we initially saw. So now that we've rebased the home business, there's actually, I think, a much greater potential for better profitability in this business. And it's one reason that we're very optimistic on the prospects for TJX ahead.
Corey Tarlow, Jefferies Vice President of Equity Research. Corey, great stuff here. Great to have you here with us breaking down some of the earnings results this morning. Appreciate it.
Thank you very much.
Certainly. Well, we just had the opening bell on Wall Street. Let's do a quick check of the markets, taking a look at the U.S. major averages, the Dow, the S&P 500, and the Nasdaq. They're on your screen. Let's run you through them real quick. Dow, up 0.1%. S&P 500, flat, just barely to the downside by about 0.08%, 0.09% now. Anyway, it's in the red. Nasdaq Composite, you're seeing that down by roughly 0.5%. We'll round that off to down 61 points. Well, Intel is stepping away from its $5.4 billion deal to buy Tower Semiconductor, that after the company was unsuccessful in its efforts to gain Chinese regulatory approval. Intel will pay Tower a $353 million fee as part of the agreement to terminate the deal, often known as a breakup fee. And particularly here, some of the details of the termination that was announced in the wee hours of the morning, 3 a.m. Eastern time. In fact, they said, at least Pat Gelsinger, CEO of Intel, saying that our foundry efforts are critical to unlocking the full potential of IDM 2.0. They continue to drive forward all facets of that strategy, and they're building momentum with customers in the broader ecosystem and investing to deliver geographically diverse and resilient manufacturing footprint the world needs, and their respect for Tower has only grown through this time period and process, but they're going to look for other opportunities to work together with them.
And we know this is a bit of a China story as well,
Sure.
you know, with the issues with securing approval for a deal like this. But interestingly enough, to me, even though Intel is getting dinged to J, it's, you know, it's marginal when you compare to how far the stock has run up this year. You know, Intel has certainly been a big beneficiary of the plays in big tech. So, you know, in the greater scheme of things, it looks like they'll be able to shake it off. You know, I mean, and then, you know, investors kind of saw the potential for this as well heading into this potential breakup. So, you know, it looks like, I mean, it's a wash for Intel.
Yeah, it sounds like they're still going to find some opportunities to potentially work together in the future. We'll see what that exactly means. They said that they're building a customer value prop with the first open system foundry, technology portfolio, and manufacturing expertise, including packaging, chiplet standards, software, going beyond traditional wafer manufacturing, which was one of the major issues for U.S.-based companies, was that they were not able to do so much of the fabrication process and had to outsource so much of that. And so now, with the funding that's come from things such as the CHIPS Act on the kind of administration front or Washington front, and then additionally how much investment is taking place to make sure that there is not that much reliance, or not as much reliance as there had been, coming into that surge of demand for these types of chips, that fabrication process that Intel is able to build out and ultimately fast track capacity production. That's going to be amazingly critical, and it'll be interesting to see exactly where some of those other partnerships start to come about to be able to bring that online in full.
Indeed. Another stock we're watching, Vietnamese EV maker VinFast. Those shares sinking this morning. This just a day after the company's market debut saw shares skyrocket up more than 200%. So put that in perspective. It's not a big drop. Now, VinFast CEO Thuy Le joined our 3 p.m. show yesterday. She spoke with our own Akiko Fujita about the automaker's plan to reach profitability by 2025. Take a listen.
So far, our shareholders have invested almost $10 billion into the company. We got the commitment of $2.5 billion more from Vingroup and our chairman. And we have made significant investment in the company in order to get to the whole lineup of vehicles that we have, the facility in Vietnam, now the manufacturing facility here in North Carolina. So we believe that with all the investments and the strategy that we have pursued, we are on the right path.
All right. Yeah. I mean, we know that stock saw a big jump yesterday, and the way they came to market was a SPAC. I mean, they had put off previous IPO plans, so they came to market in a different way. I mean, it was a huge debut, especially when you compare it to other automakers in general. Like, their market cap was outstripping, players like a Ford or, who's been in autos for eons. But again, obviously, this is an EV play. We know they have 4 models in production, 2 more on the way. So VinFast, despite today's, cooling, saw a huge debut. Yeah,
one of the things that's really been where investors perhaps have placed some of that attention to, even coming into this SPAC and the de-SPAC process that took place. I believe it was Black Spade Acquisition Company that they had this combination with in order to effectively go through that de-SPAC. They've delivered close to 19,000 EVs across some of their models as of June 30th, 2023, VinFast has. Additionally, the charging network, it spans across 63 cities and provinces. They plan to expand that further in the coming years, they mentioned. They've also got a company-owned retail and service network of over 122 VinFast stores worldwide. And so even in their go-to-market strategy, going to be amazingly critical for investors to watch where, in relation to the other network investment and scaling up for charging, for even that delivery mechanism, and just taking on new customer orders where they're able to build out that manufacturing facility as well. They were able to put a new manufacturing facility, broke ground on that in the U.S. as of July 28th this year.
Yeah, and I mean, just think about just how new this company is. It's a young company. They just started producing EVs in 2021. So it will certainly be about the delivery timeline, and we've seen that affect other EV makers. And if they don't deliver on those deliveries, there will be fallout, obviously.
We're going to be watching shares of VinFast closely. We're also watching shares of Cava.
Indeed, this morning we're watching those shares. Those are actually up this morning. The stock up about 2% there. The Mediterranean restaurant chain served up a profit in its first report since going public in June. Same-store sales soared up 18.2% from a year prior. Brooke DePalma joins us now. Brooke?
Good morning, Brad and Diane. I mean, what a tasty report from Cava. Certainly wowed Wall Street yesterday afternoon. We did see record revenue and profitability from the fast casual Mediterranean chain. Revenue growing 62% year over year to $171 million. We also saw the company turn profitable. Net income came in at $6.5 million, and that's compared to a loss of $8.2 million last year. Some other numbers that stood out to us was that same-store sales number up 18%. Now that was driven by an increase in traffic of roughly 10% year over year. We also saw price and product mix up 7.9%. And in addition to that, the company really weighing in on its rapid growth strategy here. The company opened 16 new restaurants last quarter, now bringing the total to 279. They also announced a new location in Chicago on yesterday's call, but that's a 43% increase. And so lots of Americans here are getting a taste of Cava as well as Wall Street yesterday after the bell.
Is this the next Chipotle? Is what a lot of investors have been thinking, both coming in to the IPO and even now, because the stock was actually up even more pre-market here.
Yeah, topped 11% pre-market trading,
Okay.
So certainly lots of analysts comparing this to Chipotle, but lots of analysts also focusing on the long-term potential here, just comparing it to that rival Chipotle here in terms of the white space that they have ahead of them. I mean, there is, nothing really like a Mediterranean fast casual chain. But one thing I do want to note here is that, executives here are noting that the second half of the year could look a little different. Of course, they had the IPO last quarter. They got a lot more awareness, a lot more attention. But then also the CEO noting on the call that gas prices, utility bill cost pressures, student loan repayments, and a hawkish Fed are
looming that may put pressure on the consumer and may change behavior in the back half.
That's a note that we're hearing, especially like with regard to the potential pressures being those student loan repayments, big overhang. I did like this analyst note. I love the, kind of analogies you can often go into with a company like this. Stifel saying Kava delivers a bowl of market spice out the gate. So, I found that interesting. They have a buy rating on it, and they pointed to what you said about the openings that was in line with what their expectations were for Kava. But yes, just the question of, is this a Chipotle play? And, I mean, they are unique in the type of food offerings they have, being a Mediterranean chain. Go ahead.
And no, I was just going to say that this year they plan to open a total of 65 to 70 locations. That's rather large, but really as they look to that long-term plan, 1,000 within a decade, they want to have a total of 1,000 locations within a decade. They're certainly, saturating the spaces that they're going to in order to really boost awareness. And, they do these community days when they get into new communities. And so for people who don't know them, for consumers who don't know them, they really do look to boost potential. But ultimately here, they are still, they're taking a cautious approach, they said, to the back half of the year, but they're still expecting same-store sales to grow between 13 and 15%. And they also do expect a profit margin of at least 23%. And so while taking a cautious approach, they do intend to do well in the later half of this year as well.
How are the prices right now for Kava? I mean, I'm just thinking about like the comparison. If I'm making a lunch decision to go to Chipotle or to go to Brooklyn Bagel or to go to Kava, which one's going to give me the best bang for my buck here?
I mean, I certainly do want to say that it depends on what you get here, Brad. We had a discussion yesterday that bowls can run up. My bowl average is about 13, but certainly can run up to 20. Of course, they have lots of options.
Though, if you go on the low end.
Yeah, but I'm getting very basic. Chicken, three toppings like we're allowed. I'm not going crazy. I'm not adding double protein. I'm not adding extra toppings. I'm not adding guacamole. So
you're not doing the Brian Sazzi order, is what you're saying.
I'm not doing the Brian. I'm also not doing the Ali Canal order. She said her cost like $20 yesterday. So, it really depends on what you get. But certainly, value proposition is everything that all these fast casual chains are really trying to play right now, especially as we're seeing those grocery prices come down and year over year, those fast food, that away from home category in the CPI report coming higher. And so really, fast casual and fast food really trying to double down on that value offering right now.
All right, Jesus be a salad bowl.
You get.
Rick DePalma, thanks so much for joining us, breaking down all the lunch options out there and the stock price reactions to them. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What could higher rates mean for people's portfolios?
So higher rates, a couple of things. So if you're looking at your fixed income portfolio, obviously an ability to earn higher coupon, especially on very high quality parts of the market, earning close to 5% on something like 2-year treasuries, close to 6% on investment grade credit. I think that's an incredible opportunity for those savers. I think higher rates on your equity portfolio also has meaningful implications. So sort of navigating away from areas in the market that have historically been been expensive or been non-profitable, that have relied upon negative real rates. So positive real rates is probably going to be more beneficial for areas that of the equity market that are more profitable to begin with. So looking at quality in a portfolio makes a lot of sense. And lastly, I would say that higher rates and how long rates stay high is going to be pretty meaningful for just the consumption backdrop. So how you and I spend our money. Right. So thinking about the ramifications of that on the economy, not today, but perhaps in a couple of quarters from now, and what that might do to growth, which of course will have ramifications on equities, fixed income, and commodities.
Welcome back, everyone. Let's get a check of the markets with our very own Inez Ferrer over at the Wi-Fi Interactive. Hey, Inez.
Hey, Brad. Yeah, a lot going on today. We've got the Fed minutes coming out today at 2 o'clock, and we also had some retailers reporting. And we're looking at the markets, a little bit of a mixed picture. But look, stocks are going higher with the Dow up about 0.5%, the Nasdaq Composite coming off its lows, just hugging the flat line there, and the S&P 500 up 0.2%. Taking a look at the sectors, we're looking at a little bit of defensiveness here. We're watching energy, financials, consumer staples that are higher. You've got real estate and healthcare lower. I do want to watch out for a couple things. One is over on the NASDAQ. Take a look at NVIDIA up 6.6%. NVIDIA over the last 3 days having a string of bullish analyst calls, up 8% over the last several sessions, and it will be reporting its earnings next week. And then taking a look at the Chinese ADRs. This is a 3-day chart, but JD.com today really seeing some declines down 4%. Beat, however, has not been able to shake off the Chinese gloom that we've been seeing with stocks over concerns about the recovery in China there. This is a 2-day chart, and you can see some pressure on these Chinese ADRs, guys.
While we've got you, Inez, can you tell us about that UK inflation print and how it's impacting stocks right now?
Yeah, the UK CPI rose 6.8%. That is a little bit worse than expected. Economists had been expecting a rise of 6.7% in July. In fact, services, that has gone to the highest level since 1992. You had airline tickets going higher. You had hotels going higher. Remember that it's been a big travel season, so services being a big component there that has seen price increases. As far as the British pound's concerned against the US dollar, that has gone up because investors are expecting that the Bank of England will continue to crank up rates, guys.
So it's been certainly an inflation story from here to across the pond. All right, thank you, Inez Ferrer. Appreciate that. Well, it's 5 o'clock somewhere, so we're taking a deep dive into the liquor industry. According to a recent Gallup poll, more Americans than ever are drinking hard liquor. It has now edged out wine to become the second most popular alcoholic beverage of choice, after beer, of course. We're going to talk to a veteran of the industry about what he's seeing. Our next guest has served on the executive leadership team of Beam Suntory for 12 years, spending the last 5 as CEO and president, and he's getting ready to step down on October 1st. Joining us now is Albert Bellotti, Beam Suntory CEO and president, and we also have Yahoo Finance's executive editor, Brian Sozzi, back with us. Thanks so much for joining us.
Thank you for having me again. Yes, thank you.
It's 5 o'clock somewhere.
That's right.
All right, we want to ask, so obviously you all have some well-known iconic brands. How do you kind of maintain the heritage of those brands along with appealing to changing customer tastes?
Well, look, it's about understanding what the brand comes from and being very clear to the heritage of the brand on the one hand, right? These brands are storied and they have founders that have started these, but at the same time using this history, using this DNA to kind of, springboard, connecting with the consumer, understanding where they want to go. And you talked about kind of the evolving taste in the US and the fact that the spirits industry has been gaining. As a matter of fact, spirits is now the number one if you look at value, number 2 in terms of volume. And this is all because I think consumers are gravitating more towards spirit. It offers a lot more choice than beer has, whether you want a craft cocktail or you want to have a more refreshing, lighter type of spirit. Great opportunity for consumers to kind of discover that. And we're fueling this with innovation and all the work that we're doing with our brand. So it's always about, a foot in the past and in the history and the legacy, but more importantly, a foot in the future and looking where the consumer is going.
Do you view the Japanese whiskey part of your portfolio as an undervalued crown jewel inside of the company? When I go to the liquor store, it's still behind certain cases, the price points are higher. Are people gravitating to this, and are they missing the mark?
No, I mean, people are gravitating towards Japanese whiskey. As a matter of fact, we don't have enough Japanese whiskey to go around, given the demand that's out there. And some of this is fueling the pricing that you see. And the reason for it is really very much, at least the way Suntory does its whiskey. I cannot speak on behalf of all Japanese whiskeys, but for Suntory whiskey, a lot of things come together to make these whiskeys very, very unique. Firstly is, I think, if you look at our, most important distillery, which is in Yamazaki, just on the outskirts of Kyoto, the water quality there is very, very unique. It's a very pure water, compared to the water you have in Scotland or maybe in Kentucky that has more mineral content. and it gives the liquid something quite unique. The summers in that part of the country in Japan are very hot and humid. The winters are cold and dry, and that creates also an interaction between the liquid and the wood that gives it very deeper flavors. So you have the kind of the nature aspect of it. The other aspect is that Japanese distilleries, at least Suntory's distilleries, have a lot of variety within them to create different blend profiles. So there's like 8 different pairs of copper stills. Suntory uses different strands of grain. And then there's different casks. And this gives our master blenders a great opportunity to blend to perfect taste. And then finally, I would say it's the Japanese craft and eye for quality that you see in all Japanese products around the world, which come to play. All of these factors come together to make sure, in fact, that Japanese whiskeys are very highly awarded, particularly Suntory's whiskeys. The world has woken up to those probably 20 years ago when Suntory whiskey started accumulating all these awards. And there's not enough demand to go around. We're working hard on this. We're investing a lot in capital. Hopefully in a few years from now, there'll be a lot more.
I think you mentioned something really critical there, too. And the world is also waking up to hotter temperatures. This is one of the hottest years on record for the planet Earth. So as we think about what you were mentioning in the distilling process even, how is climate change changing the distilling process and thus, for your company, the volumes that are able to be produced and thus the revenue profile of the business as well?
Well, these are things that we take into consideration for sure. And when we age our liquid, obviously we taste them and we make sure that they're ready to be released at the right times. Quality is always top of mind. But more importantly, we're incredibly committed to sustainability, and we want to play our part in ensuring that we're careful with what we do, with the carbon footprint, with everything we do around. From a sustainability and environmental sustainability standpoint, we're very vocal. This is a big priority for us. And primarily, as you said, the whiskey making is very much an agricultural process. These are very natural products. They rely on the quality of water. They rely on the quality of the wood. So we go through great lengths to ensure that we're protecting the environment around our distilleries.
And then just additionally here, when you talk about that sustainability, you had talked about even recently how this is going to change the packaging too. Laphroaig was one of those. How quickly do you see that cascading across the other brands? Should consumers expect a vastly different bottle than they've become accustomed to for all of these brands over the years?
Look, we're always innovating and evolving our packaging and our look. And we've been on a journey of doing that, obviously, over the last few years, particularly since we've introduced our brand-led operating model, where now we have kind of leaders looking after our brands and our distilleries in ways we didn't have before. I can call out, for instance, a brand like Basil Hayden, which has gone through a major packaging relaunch to great success. On the other hand, you've got a brand like Maker's Mark, which is really sticking very much to what it used to be when it was originated, and it's sticking very, very close to its DNA. So different courses for different horses, but clearly the visual identity of a brand, as you say, is something that's incredibly important as part of the marketing mix.
And so I want to ask you about any expansion plans. Are there any plans to expand the wheelhouse, whether we're talking about your whiskey or even going over to, because I'm not a whiskey drinker myself, let's say rum. You have one rum brand. Are there any expansion plans or collaborations that are coming down the pipe?
So look, we've set our ambition to be the most admired premium spirits company in the world. And that's a very bold goal that we've set for ourselves. And it means for us kind of a strong drive towards premiumization and a portfolio that tackles and addresses that and goes after the consumer need. It also means a strong drive towards ready to drink. And we're driving those two categories. So we're seeing a lot of expansion on the ready to drink side of things. And we're using both a combination of acquisitions, but also organic development to expand on the full bottle spirit side. We've introduced new brands like Roku Gin, for instance, from the House of Suntory, a brand new to world 5-6 years ago that has been doing incredibly well. We've done partnerships with brands. We've got equity in some brands. So it's a combination of organic and inorganic to make sure that we're meeting the consumer needs.
U.S. investors, I would say over the past month, are seeing slowing Chinese economy. The data continues to get incrementally worse. What are you seeing in terms of your brands over in China, and then even Japan? You know, if you compare the two economies, Japan is pretty hot right now. What are you seeing in both areas?
Look, I would say both markets have been net contributors to growth this year. China is up strong double digit. Japan is up strong double digit for us. And part of the reason is that these two countries are coming out of COVID. You know, when you look at versus year ago comparisons, you need to look at what was going on a year ago. And a year ago, those two countries had strong COVID restrictions. As the on-premise and the out-of-home channel has reopened, you're seeing tourists coming to those countries and so on. And the spirits industry is benefiting from that in both countries at the moment.
And I want to ask you, so I've been talking to some AI experts this week. They say AI can make every industry better. I find that hard to believe for certain industries, but what about technological advancements within your business? Is AI is it a factor?
It is a factor in everything we do and the way we communicate with consumers. There's, of course, productivity opportunities to be had with AI, so we're very focused on doing that. On the other hand, when it comes to whiskey making and the craft of that, we really believe that this is something that is born, is inside, and is going to be very hard to replace by machinery.
I have been very much overserved by some of your beverages over the years, and so thank you and the team for bringing that distribution to New York here, so we can all take part of it now.
Time to get out of here, Brad. Let's go.
All right.
5 o'clock somewhere.
We're going to leave with Albert, actually. Albert Biladi, who is the Beam Suntory president and CEO, and our own Brian Sazi as well, joining for the conversation. Thanks so much.
Thank you. Thank you for having me again.
We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. What has been the stock story of 2023?
I would have to say it's AI. I know everyone's saying that, but I would say artificial intelligence dominated Q1 earnings. Certainly when you see the returns, it's been concentrated in a few really mega cap names. But the interesting part of this is, on one hand, it's about artificial intelligence, but then it's also about the fact that these are companies with massive free cash flow generation. So part of it is the story about technology, innovation, AI, but then the other part is, what's the major theme? If you have positive free cash flow generation, you have that money to fund innovation, you have that money to fund further growth, and that's what the market's going to continue to pay attention to.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Diane King Hall. We're about 35 minutes into the trading session. Let's take a look at how stocks are moving this morning. They're mixed after some better than expected earnings out of Target and TJ Maxx. Still some caution about the consumer, especially heading into back to school season, but investors still seeming optimistic. We also see stocks reacting to cooling inflation in the UK and waiting out minutes from the Fed. That's to come this afternoon.
Looking at individual names, Tencent getting squeezed this morning after reporting weaker than expected revenue in its second quarter. The disappointment from Tencent adding to fear around turbulence in the Chinese economy. Still, the company did see 41% growth in profit compared to the prior year as cost-cutting efforts finally kick in.
We're also watching Coinbase. The stock is popping today after the company announced that it received regulatory approval to offer U.S. retail customers regulated crypto futures. That's going to be in the coming months, and the country's largest crypto exchange said it secured the permission from the National Futures Association. Coinbase filed for approval to offer regulated crypto products shortly after its IPO 2 years ago, and since acquired CFTC regulated futures exchange FairX, now rebranded as Coinbase Derivatives Exchange.
And we are keeping an eye on Tesla as the electric vehicle giant made more cuts to its prices in China. The luxury models S and X coming down between $7,400 and $8,500 as the company attempts to boost sales in that competitive Chinese market. In its most recent quarter, Tesla's operating margins were at their lowest for at least the last 5 quarters, down to 9.6% as it cut prices earlier this year. We will see what impact this has on the company next quarter.
Well, switching gears here, secondhand luxury retail has exploded in the last few years. The global market is expected to grow to a value of about $39 billion this year, according to data from Statista. One of the companies at the forefront of the resale game, you guessed it, StockX. And joining us now to share the big trends that he's seeing is Scott Cutler, StockX CEO. Scott, always a pleasure to speak with you and get some of the insights around this part of the seller's economy here. So what are some of the trends that are really jumping out to you at this point in time?
Well, we recently released a report we call Big Facts, and it's brands making moves. Despite the tough macro environment that a lot of the consumers are facing today, there are many brands that are showing growth year on year and across categories: sneakers, shoes, apparel, accessories, collectibles. Again, that are breaking through and inspiring this next generation of consumers. And this report highlights 25 brands that are making this ranking of the fastest growing brands on our platform.
And Scott, I want to ask you, though, about, so we've been having conversations about a more choosy consumer. And even when you think about like your luxury reseller, there's still higher costs there when you compare to, say, you know, just buying, I guess, a non-name brand bag, or even you see some of the department stores doing some of this resale business as well. What are you gearing up for when you take into account pricing heading into the back half of this year?
So as a marketplace, and as a marketplace that reflects real time with data and transparency, what consumer both supply and demand looks like, prices on our market are moving dynamically. And I think particularly in a market like this, where there is a shift from the consumer to value conscious purchases, there's still brands that are able to inspire that consumer. And they're using things like collaborations to be able to drive that consumer, which still wants to express their passion, their interest, and their personalization in what they wear. And so on our marketplace, not only do we reflect the changing value of the prices, but also a reflection of those brands that are breaking through with consumers in this market.
Yeah, I see several sneakers in that back wall that I've missed on a few of the apps that shall not go mentioned here, at least for the time being. And that's kind of pushed me over to StockX in the past and many of the other platforms that are really moving this business forward here. So now we think about this kind of environment where going in back to school season, what part of that kind of shopper mindset does StockX see come its way when you've got, you know, a student that's trying to just look hot, look fresh on the college campus, or perhaps some kid that's in K through 12 and parents want to, help them pony up for one of the old Jordan Concords or something like that. To the extent that back to school shows up in StockX numbers, is there any data that you've seen to suggest that you're also welcoming in that consumer?
Well, we're a platform that's powered by the people, and we use that power to harness effectively our lens of what current culture represents. And a couple of things that I would highlight as people are going back to school and parents or kids are shopping for the newest trends, I think what we're seeing is a shift, and this is why we highlight these new brands like On, Hoka, Solomon, New Balance are showing tremendous growth among this new generation of consumers. They're leveraging these collaborations with really interesting brands to inspire that consumer, and we expect these trends to continue through Q4. In sneakers is another example. New Balance, which narrowly missed the top 5 among fastest growing, but it is the only sneaker that ranks both in the top 10 in terms of fastest growing, but also the top 10 best-selling sneaker brands on StockX. And so this is a reflection of the shift in the consumer, but also I think a trend that we would probably see in the ramp that we've already seen in back to school shopping, but also sets a tone for what possibly could be the top selling, top growing brands going into already talking about it, the Q4 holiday season.
And Scott, I want to ask you, outside of sneakers, I'm not a sneakerhead personally. So what trends are you seeing in terms of footwear there? Outside of sneakers.
If you're not into the core sneakers, there's still things for you. Again, fastest growing Uggs, Birkenstocks, Crocs have been in the rotation. Uggs, as for example, has been the #1 fastest growing in shoes. Birkenstocks #2. Both have seen triple-digit growth in 2023. Birkenstock, for example, boosted by a collaboration with Fear of God, and Uggs saw also a really strong growth. I think if you look out into other areas, I'll take collaborations in other things. McDonald's coming up with a new collaboration with Palace on back of a collaboration with Cactus Plant Flea Market on back of what they did with Travis Scott and Cactus Jack. Again, brands trying to find that pocket of where they can inspire consumer and actually create products that are really interesting for this next generation.
We got to hustle to our finish, and we want to squeeze a few topics in. First and foremost here, the trade down, or at least how customers might engage differently during times of discretionary spending downturn. It looks different on a platform like StockX, right? It could come in the form of perhaps a longer listed time on the platform, or perhaps looking at the actual price that somebody else paid in relative or in relation to what the sale before that. And so there's a lot of last sale data as well that you and your own background and how the company has been able to move forward over the years has integrated into that experience. All that said, what is that data telling you about where the consumer is actually either pushing back on price or more cost conscious?
Well, as a platform, we've always believed in transparent pricing and dynamic pricing. And that dynamic pricing is absolutely a reflection of two things. One, supply in the marketplace. So going back to Econ 101, when there's more supply, prices come down, or when there's less demand, prices come down. And I think we're seeing both macro trends play out. And so you see that reflected in the price of many of the products that have traded on our platform for a longer period of time. But again, you see pockets where the demand is really high relative to supply. And in those places, you see in the resale market, prices spike where there is that high level of consumer demand. So StockX represents both sides of that argument. And I think generally speaking, I would still say it's a tough macro environment. But again, we use this report to highlight those brands that are able to break through and find that pocket of high demand to inspire that customer.
And then, Scott, while we have you as well, there's been a lot of talk on the street about what this IPO market, what this environment is right now. How does that look for StockX? Do you kind of look at the companies that are coming forward and making their debuts and say, you know what, this seems like a good time. This seems like an environment that we'd feel comfortable entering into?
Yeah, it's still a tough macro environment for the capital markets, and for StockX, we remain laser focused on investment in our platform, investment in our network to improve the customer experience, and expanding our platform internationally, as well as the brands and categories that we're focused on. So we're focused on the things that we can control, which is really how is it that we can drive growth on the platform overall.
And Scott, I want to ask you, speaking of just a tough environment, how do you keep customers from going to, say, The RealReal or eBay or Poshmark to find that specialty sneaker?
For us, since the very beginning, what we've been focused on is really not only having a platform that reflects current culture, but also a trusted platform within current culture. And so verification, as an example, has been a key part of our value proposition. We're a marketplace, so we stand in the middle of the seller and the buyer to verify every product that's sold on the platform. And we have a long history of rejecting a lot of products that don't meet that verification standard. In fact, over $400 million worth of products since 2016 that have not met our standards. And that leads to an experience overall that's a trusted experience. And where we don't get it right, we also have a buyer promise that backs up that statement and that promise to consumers, and we'll make it right in the event that we don't do it right. And so it's the combination of those things that distinguishes StockX from other e-commerce platforms.
You said, so when you don't get it right. So let's say I'm looking at a pair of Nike Dunk Low. Sorry, I'm not a sneakerhead. But let's say I get this pair right, and I'm like, this is not what was represented. What are my options? Like, can I return it? What's my option there if I don't like it?
Yes, you can return it. We have a buyer promise and a guarantee that if you, for example, received a product that you didn't think was represented correctly, or that we didn't do that opportunity right, you can actually contact StockX. We have chat, we're rolling out phone, and you can contact StockX and return that product in the event that we didn't deliver on that buyer promise. So you've got the guarantee of us doing the work to make sure that you get that right product, and in the fact that you don't feel that the promise has been lived up to, that you have the opportunity to get your money back. And so you're protected in either scenario.
Scott, we've had a lot of conversation, and people are probably tired of hearing, in some senses, about generative AI. But I think about the processes and the operations that StockX has and the verification of the seller and the product itself, all of these things combined. Is there a play where generative AI or any type of artificial intelligence can be leveraged within StockX and that thus protects some of the margins, especially as you do think about what a potential IPO or at least introduction to investors in the street and what they would be demanding in those margins, what they would expect in the future?
Well, whether it be machine learning or AI, it's powered by immense data sets. And StockX as a platform is powered by data and real-time data and historical data that we made transparent and visible on the platform. So we leverage that data for everything from personalization of the experience, as well as to making sure that we can stay in front of the game of verification. We use that new generative AI in things like customer service and code development. And so we're really excited about how those trends can power a better customer experience, a more responsive customer experience in the platform itself. But again, it's powered by an incredible data set that we have of current culture, of products that are trading on the platform to, again, make our process, service, and promise better for the customer over time.
Scott, if those Jordan Concords behind you are size 11.5, I'm just saying, feel free to drop them in the mail. I'll shoot you our...
Got it for you.
Not cool. That's so messed up. Okay, Scott, we're gonna have to leave it there. I mean, I guess I have to become a sneakerhead now. Scott Cutler, thank you so much, StockX CEO. We appreciate it.
Well, happy first birthday to the Inflation Reduction Act. Get your candles ready. The U.S.'s largest legislative effort to invest in clean energy. When it was enacted a year ago today, the bill pledged almost $400 billion in domestic clean energy investment over the next decade, with the goal of cutting carbon emissions by 40% by the year 2030. So, how are things coming along? Yahoo Finance's Rick Newman joins us now with more. Hey, Rick.
Hey, guys. The most interesting thing about those green energy provisions is that the uptake among businesses that want those tax breaks has been way higher than expected. So you said about $370 billion in expected green energy subsidies. That's mostly tax breaks. Well, guess what? Based on all the companies that are applying for those, it now looks like it's going to be more than $1 trillion, 3 times the original estimate in tax subsidies going out the door. And the reason that is going up is that these are mostly uncapped tax benefits. So there's no dollar limit in the law on the tax benefits. And when they estimated the cost a year ago, they were just guessing on basically estimating how many companies would take advantage of those tax breaks. It turns out many more companies than expected are piling in on this. So we're going to have an even bigger explosion of green energy in the United States than we thought a year ago. Now, there are going to be some problems down the road. Just because you build green energy doesn't automatically mean you can connect it to the grid. There are going to be all kinds of permitting issues, just as there are with fossil fuels. There are questions about where are the workers going to come from to man these factories that are getting built. But this law, if your main target is to boost green energy production in the United States, it is happening.
All right. Well, speaking of kind of the green energy play and beyond the United States, so in its first year, the Inflation Reduction Act's impact has extended beyond the U.S., Rick. So how are other global economies, world economies, joining in on this clean energy race?
Well, this was so big, and there are many what you could call protectionist elements to this bill because a lot of the tax breaks are dependent upon domestic content in vehicles, domestic content in batteries. In other words, a certain portion of the content in a lot of this stuff that's getting built has to be sourced in the United States, and those proportions actually go up over time. So other countries, in Europe in particular, Japan and South Korea, they suddenly became very concerned that they were going to lose business because of what is clearly, a protectionist measure meant to generate a lot of sourcing inside the United States. So there's been some deal making between the Biden administration and some of these other countries. There's been some changes in terms of the regulations going into place. And some of these other countries now are also doing similar things. So it's almost like there's a multiplier effect from the Inflation Reduction Act. I guess one thing I'd like to add, by the way, silly name, this act actually had nothing to do with inflation. I think Democrats who passed this law, they thought, well, if inflation comes down, we want to be able to claim credit for it by naming this act what it is. It really has nothing to do. It's really mostly a green energy bill with some other things tacked in there.
All right. Rick Newman, we will have to leave it there for today. Thank you, Rick.
Bye, guys.
Bye. The Federal Reserve's much anticipated July hike brought interest rates to the highest level in more than 20 years. With more than a month to go until the FOMC's September meeting, the Fed's next move is still very much up in the air. Policymakers have made it clear they're waiting on the latest data to guide their decision. Now, the minutes from July's meeting, set to be released today, will paint a clearer picture of how divided the central bank members are as the fight against inflation continues. Joining us now, Vincent Reinhart, Dreyfus and Mellon chief economist. Vincent, thanks so much for joining us again. So let's start with kind of a broad stroke of your expectations, what you're looking for from the minutes today.
So the two things to look for the minutes are, number one, how divided is the committee that Chair Powell has to deal with? There were a little rough edges around the last FOMC in terms of its communication, and that was probably because the chair had a hard time getting everybody on the same page. The second thing to read into the minutes is how they're interpreting the data that's come out since. How reassured were they by the better CPI data that they had gotten just before this meeting? And therefore, how comforted were they on the new CPI data? What are they thinking about employment? Is that a precondition for slowing the pace of firming. So did they therefore take some consolation, likely, the fact that employment gains were 181,000 workers last month? So number one, how divided is the committee? Number two, what are they looking for in the data about particularly activity and inflation?
And how stable are they looking for employment to continue to remain while they're enacting policy to make sure that they're seeing some type of result on the inflation side and getting more towards their 2% target as well? Because that's been the stability that they've been able to lean on thus far.
Yeah, so you're right. The employment report has a bit of everything in that it says something about the pace of aggregate demand. If you're generating a lot of jobs, you're generating a lot of income, that probably supports spending. But it also says something about how tight labor markets are. Where's the unemployment rate? Where's resource utilization? And it says something about costs. Where are wages? And it's a mixed basket for them, right? They've seen spending, i.e. employment growth, slow some, but still at a rate that is above trend. Labor market resources are still tight. The unemployment rate's 3.5%. And cost pressures are higher than consistent with their 2% inflation goal. The question is, how important are those components? Are they focused more on the slowing in headline spending, the pressure on labor resources, or their manifestation in costs? That's what you look for in the minutes.
So I want to ask you, how much more do you think it will take for the Fed to reach its 2% target? Do we expect kind of this to, late at the last round, to work its way through the system, kind of see where things are after the September meeting? Kind of like, do we expect another pause like we saw previously, or what are you expecting?
Well, I think everybody should expect no action at the upcoming meeting, another pause. And if there is action, it would be at the November meeting. Why? They've intentionally slowed the pace of policy firming. They started real fast out the gate, 75 basis points, 75 basis points. They slowed to 50 basis point hikes. Then they stepped down again to 25 basis point hikes. Now they're effectively doing 12.5 basis point hikes by pausing one meeting, tightening by 25 the next. That's what they did in June and July. If they're on track to tighten again, that means September they'll pass, November they tighten. So nothing happens in September. Do they actually tighten in November? November's a long way away. There are a lot more data on employment, on inflation. And we'll get an important reading next week when all those Fed officials gather together at the Jackson Hole Economic Symposium sponsored by the Kansas City Fed, because that'll be a key opportunity to take their temperature beyond what we hear in the minutes this afternoon.
Do signs right now point to us avoiding a recession?
Surprisingly so. The economy is still pretty robust. There's some financial indicators that are normally consistent with recession, like the slope of the term structure. Short-term rates are still well above longer-term rates. That usually heralds a recession. But spending's well maintained, employment growth is robust, and that would normally tell you that a recession is if it's coming is either going to be very mild or maybe delayed. How come? Households and firms and states had a lot of transfers still saved, and they've been working down that saving. The global economy is slower, but it's still a stable background for growth in the U.S. And recessions basically are something that creep up on you. Households and firms suddenly decide they're spending too much and cut back all at once. Hasn't happened yet.
I don't like too many things to creep up on me. Vincent Reinhart, Dreyfus and Mellon, chief economist, thanks so much for joining us here today, really laying out the picture ahead of those Fed minutes to come later on. We appreciate it.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. The National Retail Federation, known in your hood as the NRF, warned in its latest report that the annual merchandise shortage, or shrink, had risen to $94.5 billion back in 2021. 37% of that coming from external theft. During last quarter's results, over a dozen retailers pointed to theft as a key reason behind slashing their profit outlook. And Target was front and center, predicting $500 million in expected losses from organized retail crime in 2023. For more on this, we're joined by Marty Andrews, VF Corp Vice President of Loss Prevention. Marty, great to have you here with us, especially on this topic here and considering the role. How should consumers think about and investors think about, more notably here, the impact that shrink or loss have on some of the companies and how much this has grown over the years?
Yeah, so we've seen a significant uptick in organized retail crime, and it's certainly impacting the profits of organizations. So I think that the big thing that the consumers out there need to understand is the difference between organized retail crime and shoplifting. Shoplifting is oftentimes, minimized as someone goes in and takes a pack of gum or a candy bar. So we need to educate folks on what organized retail crime actually is. And these are individuals and groups going into stores, stealing massive amounts of quantities of merchandise in various stores day in and day out. So that thought process of these are big organizations and they're insured and it's not a big deal, we need to change that narrative.
So, Marty, I want to ask you about, there was a viral video recently of a huge, and to your point, organized crime event. It appeared for Nordstrom was targeted. About $100,000 of merchandise was stolen at an LA Nordstrom. What is, there have been questions about what is the solution to this growing problem when it comes to shrink, which again, to your point, is more than just shoplifting. What are the solutions that you're hearing on the table?
Well, that's the big thing that we're trying to battle, right? How do we do this? And I think one of the big things is we're decriminalized some of the activities. So there has to be a punishment for these crimes. Otherwise, people are going to continue to do them. If it's a misdemeanor to go in and do these types of behaviors. So we have to get that. We have to get law enforcement's support in these. And of course, there's limited law enforcement resources nowadays. So some of the things that I'm involved with and that are being done out there, as you mentioned, RELA, NRF, they're great organizations that are bringing retailers together. We're actually working closely with district attorneys, and retailers are working collaboratively to these. We can't work in a silo. Many of these individuals are going to multiple retail locations. So if we can work together and show that this isn't someone coming in and shoplifting one time, they're shoplifting multiple times in a day, going to different states, we're getting more traction on those cases. So it's an education process for everyone involved, but it's going to take time and it's going to take resources and definitely collaboration.
I mean, are we just heading towards even more of kind of the plexiglass wave to have an associate come over and get a product off the shelf for you if we don't see a massive change in the amount of retail theft that's taking place?
Well, we're seeing some retailers out there doing that, and of course, that impacts that consumer interaction, right? That's why people are going to retail stores. They want to be around the merchandise. They want to touch it. They want to have those interactions. So it's a fine line of how do you get that great consumer experience, but how do you protect your product? So there's a balancing act there. Of course, you're working with different partners within the organization to figure out where you want to draw the line and how you want to run your organization.
And to your point about where you want to draw the line, how does staffing account for deal with these issues? Because you have some retailers who are like, they beef up security, but some say don't even get involved when you have something like this occurring. How can staffing play out in terms of helping to address this issue?
Well, staffing is important. Security is important, but you have to figure out again where you're going to draw the line in those areas. So we want to keep people safe first and foremost. I think every retailer out there would say that. So is it a different environment in a retail store these days? And we have to continually coach on de-escalation and making sure that we're not putting our people in harm's way. So if we can educate folks that we need to stand back, we need to be safe, and then we can work that on the back end from a loss prevention standpoint where we grab the video and work with law enforcement and build those cases and seek prosecution.
Do you see this changing the type of inventory that is sold in stores versus perhaps a SKU that might be forced to go online only if a retailer is assuming that there could be a higher risk or assessing a higher risk towards a certain product being stolen?
I haven't heard of anything specifically regards to that. I think we're all sitting around a table and discussing what measures we're going to take. I don't think anything is off the table, right? You have to discuss it all and take a look at everything and make those best choices to run your business.
And is there the potential for this to get worse before it gets better? When you think about thieves becoming more brazen, targeting, I've seen some data targeting warehouses and distribution center before it even gets to the retailer. Is there the potential for that, Marty?
Absolutely. Things are happening in transit before it even makes its way to the retail store. So the threat really starts from the point that it leaves the warehouse all the way till it gets to the retail store. So definitely many issues along the way that have to be assessed, and continuing to look for different measures and different technologies. There's a lot of good technology providers out there that are working on this issue as well with us side by side.
Marty, it was interesting how you were kind of beginning to quantify how it changes the customer experience. Have we been able to really quantify the difference or the shift in a company's net promoter score even because of a change in that in-person shopping experience as a result of the changes now that have had to take place in order to curb the amount of theft?
Yeah, and I think that the incident that you were talking about earlier that happened over the weekend, I saw an interview with a consumer that was talking about not feeling safe going to that environment. So that's a scary place for us as retailers. We have to work with the malls. We have to work with law enforcement to bring that safety and that comfort back, that I can go to the mall and I can be safe and I can have a good consumer experience.
It's a tough situation across the board. We will have to leave it there for now. Thank you so much, Marty Andrews, VF Corporation Vice President of Loss Prevention. Thank you, Marty. Meantime, a new study is raising more concerns surrounding the impact of vaping. Data from the Center for Tobacco Research and the Southern California Keck School of Medicine showed significant respiratory effects after just 30 days of e-cigarette use. Yahoo Finance's Anjali Kamlani has the details. Anj?
That's right. A new study showing that especially younger adults, teenagers in high school and onwards, do have some impact after using vapes or e-cigarettes for just 30 days. They saw an increase in symptoms like coughing as well as wheezing. That was more of a concern there. Users of vape in the last 30 days saw 81% higher risk of wheezing. And they also looked at co-users, so those who are using traditional cigarettes and cannabis. This center has been looking at this for some time. They saw an increase of wheezing then. And they also noted that this is, of course, the ongoing struggle with flavored e-cigarettes. And that is really the crux of the situation. A July study showed that 71% of respondents said that they would not use these if it weren't for those flavored products. We know the CDC has been tracking this, saying that sales of e-cigarettes have gone up more than 46% during the pandemic, something that they monitored as, we saw increased use of other substances as well during that time period. And it's important to note that flavors are continuously the problem that both the FDA are trying to regulate and CDC are monitoring because of the appeal to youth. That's something that they noted continues to be a trend across the board. We've seen the number of popular brands like Juul, Elf Bar, Escobar, Enjoy, Breeze Smoke, and Views among those that are being used by these teenagers. So this study just goes to show sort of that impact, that broader impact that we're seeing. And in the broader context of public health, the reason why we keep getting these data points and ongoing focus on this is because of what we've seen during the pandemic, COVID-19, increased risk of complications as a result of poor lung health, increased costs of care. Your insurer constantly will ask you if you go to a new job, if you smoke or don't, and that really affects your premium. Asthma, coughing, wheezing, all of these impact other health complications. And we've also seen with climate change, extreme weather, you've seen excess heat and excess smoke affect those with poor lung health. And that also goes to the indoor quality issue, which we know is all interrelated. So a big problem that the CDC in particular is focused on as it relates to public health, the younger generation, and ongoing potential health outcomes.
And Anjali, while we have you, Juul is also looking to make a comeback in the U.S. What can you tell us there?
They are. We, of course, saw that saga unfold, and the focus on Juul's marketing to teens, well, they are now trying to check with the age-related products. They're going to try and get age verification in on their products, and that's something they're looking for FDA approval on to get back. And they lost ground as the leader in the U.S. to Elf Bar and Escobar, too, that have had crackdowns because of their illegal fruit-flavored products on the market. So just a lot going on when it comes to what this segment of the market is going through and how much more illegal product is still out there.
All right. Thanks for bringing this conversation back to the forefront. Anjali Kamlani, thank you. More of your markets action ahead. Stay tuned. You're watching Yahoo Finance.
in a surprise move, China's central bank cut two key policy rates after a broad array of data across retail sales and investment came in softer than expected on Tuesday. Will Beijing's latest move be enough to jumpstart the economy?
The data releases we've seen over the last week or so have been not just weak, but I would say outright alarming. Now they're cutting rates by 10 basis points. It's hardly a game-changing policy. I would say we're getting to a point of like incoherence in the policy framework, which is not really generating confidence. And you can see, okay, we had a rate cut and equities were down, right? So that's not what you want to see as a policymaker.
So China ramping up its easing efforts, more concerning economic data coming out today. How much trouble is China's economy in?
The Chinese economy is definitely under a significant amount of stress right now. The key thing to watch here is the real estate sector. This has been now the 28th month of declines in new construction activity since it reached its peak in 2021. And that has a big impact across the economy, not least on local governments who have relied on land sales to balance their books for years and are now under a considerable amount of stress.
Chinese officials are reportedly considering cutting the stamp duty on stock trades in order to boost the world's second largest equity market.
This measure would really be a boost for Chinese equities if they were to cut that stamp duty. A stamp duty is like a levy on stock trades, and this would be the first time that it's cut since 2008.
Chinese economy has been sputtering without doubt. Something that has bucked that trend has been Chinese crude imports. But if you look at everything else on the macroeconomic front, whether it be their exports, their industrial production, manufacturing activity, deflationary pressures, all of that is just big, bad news in bold letters.
I've been covering China for about 20 years. I've never seen this type of weakness where it feels like you have a real confidence issue, and that's certainly going to have spillovers into stock markets around the world. I'm surprised we have not seen more spillover. Like, given the severity of this consumer confidence crisis in China, I think we will see more spillover than we've seen to date.
The trouble in China continues. New home prices in the world's second largest economy fell in July for the second month in a row, adding to concerns a growing property crisis will further slam a struggling economy. At the eye of the storm is troubled developer Country Garden, which missed bond payments this month. And now, according to Bloomberg, a large trust could also be approaching default. This morning, the People's Bank of China stepped in to inject the largest amount of short-term cash since February. Joining us now is Dennis Unkovic, Meyer Unkovic and Scott Partner. Dennis, thanks so much for joining us this morning. So first off, I guess from your perspective, how much worse could it get for China's economy?
Diane, I think it could get a lot worse. Let me just give you one statistic. 70% of the household wealth held by the normal Chinese people is in real estate. When real estate goes down, it just doesn't affect the markets, it affects everyone in China. So as one of your former guests has said, I have never been this concerned about Chinese economy in my life.
Are we witnessing the makings of a lost decade for China?
Well, if you go back to the mid-1980s, Japan was going to be number one. It was going to control the world. So between 1986 and 1992, it went through its bubble period. But it hit a situation pretty much like today, Brad. A lot of money was invested in real estate. Real estate prices went crazy. And then all of a sudden there was a collapse because Japan then suffered from deflation. So their Nikkei, which was their stock market in 1992, which was about 30 or 32,000, dropped to 8,000. And really, I think it's probably only been within the last year when it's gone back up. Deflation in Japan looks a lot like you could see in China.
And then, Dennis, I want to ask you, just in terms of, so the real estate sector, the latest shoe to drop, if you will, there in China, what does China need to do? Do they then have to turn to households to stimulate their economy, or is there not enough there?
Good question, Diane. Two things. No, there is not enough there, in my opinion, for the Chinese to deal with it. The fact that they dealt with the 10 basis points and last week said to real estate companies, we're going to give you another year to pay off on your debts, it's not enough. I think it would take significant intervention by the Chinese at this point. It hasn't come. I guess yesterday, we're Wednesday, but on Monday there was a meeting of the Politburo, which is the senior ruling group in China. And they looked at this situation. They said, we're going to work on this. We're going to deal with it. At this point, I think the Chinese leadership has done too little. Hopefully, it's not too late.
Dennis, a friend of the show, Matt Maley from Miller Tabak, said in his morning note, we're getting very close to removing the word potential from the term potential contagion. I would love to get your perspective on that. And if so, and if that is to be true, then what other parts of the world, what other parts of the stock market even, when you think about U.S. companies and international companies that rely on China for some of their growth and additionally some of their partnerships to everything from manufacture to sell into the economy, how could that impact them further?
Brad, let me take that in two parts. First of all, the first people or the first countries to be hurt significantly will be those in Southeast Asia, because they not only sell a lot of stuff to China, but the Chinese have orders coming back and forth. I think that their markets will be hit first. As we know, the U.S. economy is fairly healthy today, but eventually a weak China exporting less and importing less from the U.S. is definitely going to affect the markets.
And Dennis, I want to ask you about that move that China made this week about the reverse of pulling back the curtain, kind of closing the curtain on that data on employment. What should we make of that? I mean, you know, we know China is obviously not a democracy, so there is an opaque nature there in general. But how concerning is that, and are we concerned enough about that?
Diane, in the best of times, China has never been transparent. It's been a little bit more transparent recently, but I think what you're referring to is Chinese youth employment, which is under 25, I think is about 21 or 22% now, which is at an all-time high. When the Chinese saw that, that's the kind of news that I think the central government really doesn't want to have out there. So the semi-transparent China has become very opaque at this time. And that's really typical for the Chinese. Whenever you see, for example, during COVID, when the Chinese economy was dropping in 2021 and into 22, the quarterly estimates of the growth of what would come out in China weren't brought out by the government. And so they are not happy to have bad news out there. And I think this is a good example, Diane.
In a series of shocking moves that have been made by the government with regard to and response to the economic data that they are seeing, what is the next shoe to drop from your perspective?
The next shoe to drop is, I think, that their real estate market is going to get even worse. There's a Chinese trust company called Zhongju, if I said that correctly. But as a trust company, it's a shadow bank. Banks in China today pay you 1 or 1.5% if you deposit money in there. But these shadow banks, the trust companies as they're called, will pay you 6 or 7 or 8%. Zhongju announced yesterday or Monday or Tuesday, whatever day it was, that they were not going to be able to pay back their obligations to their folks. Zhongju is an example of a trust company that has 1 trillion yuan or renminbi money sitting there. So if you're an average Chinese person, you have a lot of your money invested with them, and then you see the real estate market dropping, it's really very serious. I do not see a quick end or a quick improvement to what we see, Brad.
Dennis, thanks so much for taking the time, providing some insight and perspective here this morning on a very large matter that everybody in the investment and economic community should be paying close attention to. Dennis Unkovich, who is the Meyer, Unkovich and Scott partner. Thanks so much for the time.
Thank you, Brad.
Okay. Switching gears here, Apple is reportedly launching into its iPhone 15 production in India, according to Bloomberg, with the tech giant's supplier Foxconn set to begin prepping for delivery out of its India factory just weeks after shipments out of China began. Yahoo Finance's tech editor Dan Halley joins us now with the details. Hey, Dan.
That's right, Brad. Apple is reportedly beginning production of its iPhone 15 in India. It would probably start sending them out weeks after they began shipping out of China. Now, this is a big deal. Yes, there's a lag between when it comes out of China and when it comes out of India, but previously, India was only building older models of iPhones, not newer ones. And so they began building newer ones with more recent iPhones, and now that they're going to almost be shipping them out around the same time that they begin shipping out of China means that Apple is putting more of a kind of emphasis on what it can do as far as India production. Now, they obviously work with Foxconn, Windstrom, other companies as well. There's talk about Foxconn moving deeper into India, but the vast majority of their plants are still in China. The vast majority of their production is still in China. And Apple is trying to diversify that. This comes after, obviously, the COVID shutdowns that we had seen in China, the supply chain disruptions that resulted in that, and then the U.S. Beijing tensions that we're seeing continue to percolate. And so Apple is trying to make sure that it still has the capacity in India, but in China rather. But, if anything goes wrong, it can lean on capacity in other places. It's not just India, by the way. They're looking at Vietnam, Indonesia, places like that as well. And so, if something does happen where, the U.S. blacklists certain Chinese companies and then China decides to retaliate by potentially going after Apple, which is something that a number of groups have brought up, and Apple probably fears itself, then it wouldn't necessarily be caught without the ability to produce iPhones globally, but it would be hit substantially for that production capability. But now, as we're seeing, they're moving forward with the ability to build in India, and that's a positive sign for Apple.
And Dan, really quickly, there's apparently a new update coming to our iPhones. I guess this is going to be a call feature. What can you tell us there?
Yeah, this is something that's kind of been talked about online. It's a little silly. The call button, the end call button moved for a minute on the iPhone during the most recent iOS 17 beta. Mine hasn't moved back to center. It was originally in the center, then it moved to the right side, and then it moved back to center. Mine's still on the right side because I didn't update to the latest version. But the reason for that is because of these new features. This feature they're rolling out called Contact Poster, and basically, when you call someone and you see their little emoji or memoji at the top of the screen, or a picture of them at the top of the screen, that's going to expand dramatically. So it'll be a huge kind of portrait of the person. That's why it's being called Contact Poster. And so they had to move some of the buttons to make way for that. And so that's what we're seeing here is Apple just kind of fiddling around with the UI. They do this from time to time. A while back, they did it with Safari, where they moved the address bar down to the bottom of the screen, and nobody seemed to like that, so they moved it back up to the top of the screen again. But you could expect some changes here and there whenever you go through a beta, but it by no means that that's what we're going to see when they finally roll out the full version this September.
All right, just keep one of the buttons the same. My goodness. Something that we can rely on day in, day out. Dan, thanks so much for breaking this all down for us. We appreciate it. Dan, always there when we need him to be. And lastly here, everyone, we got to let you go, but Rochelle Akufo has you for the next hour of trading. Much more markets action and chatter and talk on the other side.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. All eyes are on the Fed today with minutes out at 2 p.m. We'll break down what investors should expect this hour. And Walmart earnings are next up after Target sales took a hit in the last quarter. Is it a sign of what's to come? Plus, where does your university rank? From financial aid to career services, we'll break down the results from the Princeton Review's Best Colleges report coming up later this hour. But first, let's take a look at how the major indices are faring an hour and a half into the trading day, looking at a mixed picture and a lot of volatility as investors digest earnings and await those Fed minutes. We see the Dow there up about 128 points. The S&P 500 there also just barely in positive territory, up about 0.2% or 9 points. Tech-heavy Nasdaq taking a slight hit, but ever so slightly, down about 7 points so far this morning. Let's also check in on the Treasury market as we await those Fed minutes. We see that the shorter-term yield there, as we can see there, down about 0.78%. The 10-year, as we can see, look at the yields on that at 4.2% now, as we continue to see some movement there as we await the Fed minutes, and we've been seeing it above that 4% target for a while now. And the 30-year yield, the one in positive territory, but ever so slightly there, as we can see at 4.32%. Well, investors are eagerly awaiting the latest Fed minutes coming out this afternoon. Now, they'll be hoping for a more dovish tone from members and a lean towards a pause in interest rate hikes for the September meeting. But some recent quotes from voters on the committee tells us that the hiking may not be over. Minneapolis Fed President Neil Kashkari saying during an interview, quote, "I'm not ready to say that we're done. Inflation is coming down. We've made some good progress, but it's still too high." And San Francisco Fed President Mary Daly telling our very own Jennifer Schonberger there's still more work to do. It would be premature to project what I think would happen because there's a lot of information coming in between now and our next meeting. Joining us now is Omar Aguilar, Schwab Asset Management CEO and CIO. Good to have you back on the show here. So give us a feel of how investors are feeling here. We're getting some of this Fed speak ahead of what we are getting from the official FOMC meeting minutes here. How are investors feeling right now about this picture that they're in?
Well, thank you. Thanks for having me. And the minutes today will be an interesting, take on where the Fed officials may be thinking for the, in anticipation of Jackson Hole, but also in anticipation of their September meeting. A big part of this, ends up being what the tone of the minutes might be. On the one hand, you will probably hear or read on the minutes that there is this encouraged optimism that there is disinflation, that inflation picture starts to just work itself down. They will be very cautious in the way that they describe that as to say, well, there's still work to be done. They don't necessarily want to say that this is victory, and therefore leaving the door open for potentially still working on that. I think the market will be looking at, and the market is already thinking that there will be a pause, coming on in September. But I think as we continue to see on any given day, new information, the Fed officials are also tracking that, and again, trying to leave the door open for what they may want to do. So a lot of what I think the minutes will reflect today is consensus view from the officials, and whether or not they're leaning more dovish or whether or not they're just going to become incredibly neutral, just leaving the door open for potential more work on interest rate hikes.
And as all this information continues to roll out, where we're seeing some interesting calls here, Vantage Point Asset Management's Nicholas Fress suggesting a hard landing and a correction in the equity rally coming up in the fall as some of the realities of slower U.S. growth, as well as some of these seasonal factors start to kick in. Is that how you see it as well?
We're not as as bearish in that circumstance. I think what we're seeing here is a very unique cycle that we have seen economically and just markets as well. And we have gone from calling a recession and a disaster from the last 18 months. I think the most pronounced recession has been called pretty much every quarter since the middle of 2022. And I think what we have seen is this concept of rolling recessions that in our concepts tariffs, we're now feeling that we're in this, area of rolling expansions or rolling recoveries. And if you think about it, even just the recent, housing data this morning, it still continues to see that while the housing, market was in pretty serious, recessionary territory at the end of last year, over the course of this year has started to recover, even in the case of having incredibly higher mortgage rates. So we see that component of potential stabilization, that we see that these expansions or these recoveries continues to be in different parts of the market. A lot of what I think we're seeing is this competition between slowdown of the economy, as well as just the potential, how fast these inflation numbers come back. And at the end, the big, question mark is how much the consumer can maintain that leadership of maintaining the economy growing at the pace that we're going now.
And that is a question that we keep asking ourselves. We keep saying, talking about the strength of the consumer, and then we see this retail sales data, coming in hotter than expected as well. But then when you look at what the stock market is doing, I mean, we have Michael Burry of Big Short fame with this $1.6 billion bet on a stock market crash coming up this year. Do you see anything that's really going to push the markets into correction territory as you look ahead?
Well, great question, and we gotta understand that a lot of the earnings pictures that we have seen and a lot of what the market fundamentals run basically end up being very tied with what the economy is. And so far, if you look at the trajectory of GDP and the trajectory of earnings, they have been very, very consistent. So when you can actually see that, yes, in the results that we had on the second quarter earnings, we saw that contraction was the third quarter in a row of contraction, which was consistent with the slowdown of the economy, but still, growing at a pretty good pace. In fact, the results were pretty consistent, beating estimates. Yes, there were, there was an erosion of earnings, but there was not a capitulation of earnings, was just a disaster. So when you look at those and when the market looks at fundamentals, a lot of what the earnings, produce and what the forward-looking earnings may look like is in certain parts of the market, things are expensive, but in the general sense of the market, there's still a lot of opportunities for things to look, pretty attractive. Now, what I would actually say, though, which is, part of being cautious and being, in a way, taking a more broad view of the market is we go back to look at the 5 C's. And that when we say the 5 C's is things that are actually going to matter for the fall include China, which is a significant, new information that we have seen, especially in the last couple of weeks. The consumer claims to just get a sense on the labor market, the credit market, which is going to be an interesting thing to continue to monitor over the next couple of months, and of course the consumer, activity. So when you look at those 5 C's, that is something that we started seeing at the beginning of 2022, they're coming back into vogue as to see what are the things that we need to continue to watch to understand where the market will go from here.
That's great. We'll be keeping track of those 5 C's. There's, of course, a lot of investors trying to sort of pass through all the data that's coming at them. We do appreciate you joining us with your insights, as always. Omar Aguilar, Schwab Asset Management CEO and CIO. Thanks so much. Well, the yuan is on the verge of falling to its weakest level since 2007. The People's Bank of China stepped in to inject the largest amount of short-term cash since February. But is it enough? Here with more on this is Yahoo Finance reporter Inez Ferrer. Inez, what are you watching?
Yeah, Rochelle, well, China is trying to build up investor confidence, and the People's Bank of China is trying to keep its currency stable, but also lowering borrowing costs in order to boost its economy. Now, just this week, the PBOC cut policy rates, key policy rates. It also injected the biggest amount of short-term cash since February into its financial system, lowering borrowing costs. And at the same time, keeping a currency stable, well, all of that is very difficult because if you have a weak yuan, overseas investors won't want to be inclined to invest. And at the same time, Chinese companies will not want to convert US dollars into yuan because they're seeing their currency being devalued. Now, often it's important to point out that when the Federal Reserve in the US raises its rates, the rest of the world often follows suit because it's forced to in order to protect protect their currency, because as the US dollar goes up, foreign currencies go down. So in this case, while some other countries have been maintaining high rates, China has been lowering its borrowing rate, and that is impacting its currency. Now, the PBOC also warned traders, by the way, recently not to keep gambling, saying the foreign exchange market is a big deal and maintaining stability is their first priority. Rochelle.
And we keep seeing these warning signs. I mean, there are reports that large funds have been told to avoid being net sellers of Chinese equities. What do we know about that?
Yeah, Bloomberg is reporting that the Chinese officials asked large funds to avoid selling these onshore equities more than what they purchased. Now, this is one of the measures that the government is taking to try and shore up stock prices, because the stock market often is really a barometer for consumer confidence. And right now, property values are declining in China. Individuals have their wealth tied up in their property values. And if the stock market is also declining, it has a massive, really psychological impact on consumers. Another idea that's also been tossed around recently is to cut a stamp duty on stock trades in order to shore up investor confidence. That hasn't been done since 2008, Rochelle.
Certainly strange times, and we're actually seeing, the Chinese government trying to manage this, but don't seem to have a handle on it at the moment. A big thank you there to our very own Inez Ferre.
Thank you.
All right, all your markets action is still ahead. Stay tuned. You're watching Yahoo Finance.
So this morning we got better than estimated economic data. Stocks are down. Are we sort of back in that environment where better or hotter data is going to be bad for equities?
I think we shouldn't, I don't like the narrative around good is good or good is bad. I think we have to look at what the market has done, the totality of the moves this year, this last couple of months, where, equity markets have had a tremendous run. And we need to come to terms with the fact that if we are now going to be in a higher for longer environment, that will have some ramifications on discounting mechanism, discounting rates of equities. So I don't want to point it to, good data is now bad for equity markets. I would just say that we need to think about valuations a little bit.
Insulin has always been difficult to obtain, particularly for those that can't afford its steep prices. Well, Amazon Pharmacy just announced it will help by easing prices with a new coupon system, helping customers gain access to the drug. Let's bring in Yahoo Finance's Anjali Kemlani to give us the details. At least some welcome news here for consumers.
That's right, Rochelle. And also something that is a continuing trend, if you will, Amazon basically joining in the queue of outlets or access points for diabetics to get insulin at this reduced price. So what have they done? They've instituted an automatic coupon for that $35. That's something that you have seen the price of in a lot of other places, but what they're doing is making it easier for for individuals to actually get it at that $35 price. It applies to 15 products, including pumps and the like, for all of these customers. The manufacturing coupons that are being put in place come from Novo Nordisk, Eli Lilly, and Sanofi, and the other two companies are product makers, so it applies to all of these insulin products. What's really interesting about this is that we know that coupons are not new. The manufacturers themselves have earlier this year and in the last year or so been bringing prices down to that $35 mark, and in fact offering free products when applicable. We know that pharmacies as well have been offering these through their membership sites. But what's really interesting is that we know that this process is not easy, and that's really what the bulk of my discussion was with Chief Medical Officer of Amazon Pharmacy, Dr. Vin Gupta, who told me he knows that coupons have been around since before Amazon Pharmacy was even in existence, but that, quote, people either don't know about it or simply can't get access to some of these to these coupons because of inefficiencies, and that's what they're hoping to solve for here. So anybody can now get that automatically applied at checkout rather than having to find the coupon, redeem it, etc. And so that's really where the game changer is right now for this.
And transparency really is key, because a lot of times you don't even know to ask for these coupons, or you just assume you don't qualify for them. So there's certainly more transparency, the better. Big thank you there to our very own Anjali Kemlani. Thanks so much. All right, we'll take a look at Walmart, set to release earnings on Thursday, and investors are eyeing foot traffic, inventory, and same-store sales across all of the retailer's brands. Let's bring in Yahoo Finance's Brooke DePalma to break it down for us. Hey, Brooke.
Good morning, Rochelle. That's right. So many on Main Street and Wall Street look to Walmart as a consumer bellwether, really where consumers head to seek value with what they call their everyday low prices. And Wall Street certainly looking to see Walmart win this past quarter as consumers look for value in this inflationary environment. Analysts expecting net sales to come in at $159.7 billion, adjusted earnings per share to come in at $1.70. Same-store sales also expected to jump 4%, driven by Walmart's U.S. same-store sales up nearly 4.3%, and Sam's Club U.S. stores up nearly 5.6%. Now, certainly Wall Street saying that Walmart is well positioned in an uncertain macro environment with its price, value, and value proposition. Another analyst saying that those limited time sale prices, what they call rollbacks, continue to drive price leadership in this sort of environment. And analysts really expecting a combination of an expense discipline and more favorable merchandise mix to really drive continued earnings strength. And something else that we're watching for is that traffic and ticket price. We do expect to see a boost there of traffic up 1.6%, tickets up 2%, as perhaps consumers look for more of those affordable options there at Walmart. But ultimately, Wall Street really expecting a strong quarter here for Walmart, as once again, consumers remain pinched by those higher gas prices, higher grocery prices, higher interest rates, and so many other headwinds against them.
And Brooke, Walmart also investing heavily in two aspects of its businesses, its ad business, in addition to its health and wellness. What can you share there?
Yeah, well, those are two growth drivers that someone in the street are really saying are huge, sizable opportunities for Wall Street to really, make headway this year. Kicking off things with its ad business, Walmart Connect was first introduced back in 2021, and one analyst says that this can now be a multi-billion-dollar opportunity. It's its ad sales business, and what it's really looking to do here is that omni-channel approach. And before the annual shareholders meeting back in May, we heard from the SVP of sales for Walmart Connect that when so many are looking to perhaps reduce their ad spend, so many are also looking to Walmart Connect to really
make headway to reach those consumers with this, once again, omni-channel approach. And in addition to that, it's other business, that health and wellness business. We saw them announce the end of their partnership with National Vision. That's expected to end in 2024. But at the same time, it's bulking up its health and wellness business. By the end of 2024, it aims to double its footprint with Walmart Health to more than 75 health centers. In addition to that, we also heard them raise wages for both opticians and pharmacists earlier this year. So two sizable opportunities there that we hope to hear more from in the call tomorrow, Rochelle.
Indeed, we'll be keeping track of that. Stock price relatively flat, but up more than 12% year to date. We know you'll keep us up to speed on all of that. A big thank you there to our very own Brooke De Palma. All right, well, all your markets action is still ahead. Stay tuned. You're watching Yahoo Finance.
What has been the stock story of 2023?
I would have to say it's AI. I know everyone's saying that, but I would say artificial intelligence dominated Q1 earnings. Certainly when you see the returns, it's been concentrated in a few really mega cap names. But the interesting part of this is, on one hand, it's about artificial intelligence, but then it's also about the fact that these are companies with massive free cash flow generation. So part of it is the story about technology, innovation, AI, but then the other part is, what's the major theme? If you have positive free cash flow generation, you have that money to fund innovation, you have that money to fund further growth, and that's what the market's going to continue to pay attention to.
According to the World Economic Forum, the priority in global diversity, equity and inclusion programs is still focused on women, accounting for 79%. With the gender wage gap showing signs it's sluggishly closing and the focus still being put on social issues, investors are thinking about where to invest to help build more equity in the marketplace. Let's bring in Newton Investment Management Senior Portfolio Manager Julianne McHugh to discuss BNY Mellon's latest ETFs and how they may help to address inequities in the markets. This part of the ETF report brought to you by Invesco QQQ. Thank you for joining me this morning here. So break this down for us. These two ETFs here. First, starting with BKWO, the ticker there, the BNY Mellon Women's Opportunities ticker. As we see that there, really a focus on tech and health in these holdings. But talk about how this ETF came about.
We approach this as, there's a lot of different ways we can attack gender equality. We approach building this one as, first of all, as investors. Second of all, as professional women who have gained experience in terms of what has worked and not worked with regards to equality. And third, also as mothers of boys, because for us, it's not about prioritizing women over men. It's about recognizing that each gender needs different circumstances in order to flourish. And so what we wanted to do is identify those companies that are identifying those opportunities that will enable women to reach their full productivity and help to close the gender gap. And
so
Yeah.
Well, I was going to say, as we look at some of the top holdings there that you have here, talk about why you've picked those, because there is that very heavy focus on tech and health. Why specifically those?
Well, there's two aspects of the kinds of companies that we'll invest in. First is those that embody those practices that enable women's opportunities. Similar to what other people do in the industry, we are looking at things such as the benefits that the companies offer, as well as participation levels, not only at senior leadership methods, but also throughout the organization. We're also looking at the opinions, though, because there is evidence to show if you pay attention to the human capital and that people are happy, those stocks do actually have higher returns. So with regards to the tech investments, those many times are in our embodied category. Those are companies that are really providing those opportunities and those equal opportunities to women in the workforce. The other aspect and why we have potentially more weight in the healthcare industries is the other category of stocks that we look at, we think is a little different than what's out there right now in gender products, is we look at those companies that are delivering products and services that will enable women to stay fully participating in the workforce. Right now, according to the Department of Labor, women still have more of the unpaid responsibilities than men. Some of that is taking care of dependent care, but there's other aspects that might limit my ability to stay full-time engaged, which it has to do with some health issues. And so those companies that are providing those health services that are unique to women or providing those dependent care, such as elderly care services, end up becoming things that we think help increase women's opportunities. And that's another reason why those healthcare names seem to be a higher weight in our strategy.
And even as we look at the data here, by having more women in the workforce, as we look at some of the data here in terms of workforce rates, that we could potentially add $28 trillion to the economy if women participated equally to men. These are stunning numbers here. So you would think we would see more investment in this space, but it does seem like when you present the data, you sort of get hit with that stigma, as we saw with ESG investing, as it's something nice to have or something woke. How do you avoid that when clearly the data shows that it's backing up what you're saying?
I think that's what we just have to rely on, is that, first of all, that 28 trillion, as you said, is what could be added. That's more than the GDP of the United States. And there's going to be some voluntary reasons why women might not participate fully, but there's some involuntary reasons as well, which I addressed with regards to whether it's health issues or whether it's dependent care responsibilities. The other statistics that show the support for why we really should care about closing this gender gap is that, the studies show that companies that have diversity in senior leadership outperform those that don't have any diversity in terms of profits, in terms of stock performance, in terms of returns on assets. Studies also show, as I mentioned to you before, human capital needs. Not only are the companies that are appearing in the Fortune 100 or rated highly on Glassdoor outperforming those that aren't, but there was another study I saw recently that looked at how Glassdoor male versus female employees assess the company. And those that have a narrow disparity outperform those that have a wider disparity. So caring about where that gender equity is and that equality has financial returns and implications.
And of course, we have to talk about the other ETF as well, the innovation one. Talk about some of the companies that you're focusing on there, and perhaps any concerns that you have about some of these huge valuations and this equity rally that we've seen, and how you're really sort of managing some of the holdings in there.
Okay, well, so that is not my, I am not the manager on that one, but I will say that that is something that we do as an organization, is really look at those innovative companies that are building a moat and has the strong management power that can really withhold. I mean, if you look at NVIDIA, you know, they are just embodied into everything within AI and is a real leader in innovation in order to provide that industry aspect. So, and CoStar really is, you know, the aspect of a company that really is the material difference with regards to the real estate market. It's sort of the Bloomberg of the real estate market in terms of the data availability.
So certainly a lot to watch there for, and you know, for people to expand their horizons about how they invest. A big thank you there to Newton Investment Management Senior Portfolio Manager Julianne McHugh. Thank you so much for your time this morning.
Thank you very much.
Well, generative AI technology has seen the biggest growth this year, infiltrating everyday apps, software, and businesses, and the retail space is in need of these innovations as well. Our next guest says that customer satisfaction is at a 17-year low, and despite technological advancements, call centers and retailers are stuck with legacy FAQ bots. Now, AirKit.ai set out to change the retail space with the launch of its latest AI product, which will update the customer experience, making it faster, more intelligent, and seamless. Let's bring in AirKit.ai co-founder and CEO Stephen Ehian to discuss how AI is innovating the retail space. Thank you for joining us this morning. So, talk about what made you decide to focus on this aspect of it? I know a lot of us sort of have a lot of frustration with a lot of these sort of customer service bots. What can AirKit do differently?
Rochelle, thank you for having me. I think you said it. The problem we're solving is very relatable. It's frustrating customer experiences. And we started this company 5 years ago to help every business launch just incredible customer experiences. And selfishly, you know, as consumers of products, we think of what's the ideal experience we want to have and work backwards to help companies launch those experiences. So the opportunity with generative AI, we're launching AirKit.ai for commerce. This is really leveraging the AI agent technology to help service teams really exceed their customers' expectations in very helpful and unexpected ways.
So talk about some of the clients that you work with here and really the sort of the expectations for how much this is going to impact their bottom line by really making this a more seamless experience.
Yeah, so let me kind of give you a sense of where the state of the world is today. So major retailers and e-commerce brands are using what we call FAQ bots. Their goal of these bots is really to deflect the customer from kind of an expensive channel like a live voice into a digital experience like a help center article. This deflection doesn't actually resolve the customer's needs. We've all had it. You call in, the company says you can actually resolve this by going to www.x.com, and it's an obstacle to resolving your issue. What AirKit.ai for commerce is focused on is resolutions. It's in the context of a conversation. You can return an order, you can change subscription, you can change your address, you can get a product recommendation. I think the beauty that we saw with ChatGPT immediately was how fast of a response you can get. Obviously, with, write me a poem, it writes you a poem. But now imagine a world that you're able to have a conversation with a brand and you say, I need to make a return. I need to look at my loyalty points. I'm looking for a specific type of product. What recommendations you have, and having it resolved on the spot. So when you think of the outcomes we're driving towards is 90% resolutions with our customers. So instead of having to deflect it and try to resolve it yourself, you're able to resolve it on the spot. Rochelle, the other benefit is by resolving immediately, you eliminate the follow-on tickets that usually are created within companies. So typically with our customers, if things aren't resolved immediately, customers will email you in. They'll try to call you 3 to 4 times until it's resolved. So that's eliminated up front.
So talk about how you're training these AI models. I know that that does tend to be something of an issue, something also that regulators are looking at in terms of data that's being used to train some of these AI models. How does AirKit go about that, and perhaps without stepping on the toes that would draw the ire of regulators?
Well, there's three key components of our use of AI, and we really try to replicate what the ideal customer service representative is able to do. And if you think of the best service experience you've ever had, that representative is able to provide context to the interaction. They have a sense of your order history, your communication, your preferences. They can make recommendations. These agents, these representatives also have knowledge of the company business policies, when to give a refund, when to provide a discount, how to treat in different situations a VIP customer versus a first-time user. And these representatives also have access to all the core systems of a business. And you talk to retailers and e-commerce brands today, they have on average 12 different systems they have to interact with. So AirKit AI for Commerce, what we're doing is actually train the models on your business policies automatically by looking at past interactions and any written documentation you have. We're also able to get context by looking into your core systems to understand the history of the customer communications. And we're actually able to resolve issues on the spot, leveraging our pre-built one-click integrations into your core systems. So that kind of that combination of the integrations plus your business policies plus knowledge and insight of your previous interactions is really how we're leveraging generative AI today.
And we're certainly still in the earliest days of generative AI. Where do you see the customer service experience going from here? As some of these LLMs, they do learn more about how we are. What does the future look like then for customer service, you think?
Well, we think about this a lot of like the customer journey, and historically, the interactions between marketing, sales, and service has been very siloed. And they've kind of developed over time based on the departments and the structure of the organization. You think of the opportunity with generative AI, it's to really break down those silos between the departments. And what is a great service experience? Well, a service experience is resolving your immediate issue, but it's also giving you understanding and education of what else is available in that brand. So really think by starting in service, we're getting an entry point into every business, but also an ability to kind of expand beyond just service as you think about sales and marketing to kind of create that perfect continuous journey from start to finish. And I think that's what we're going to start seeing in the future, which is kind of breaking down the silos between the departments of marketing, sales, and service.
What about people who are just not comfortable with sharing that sort of personal information with AI? Some of the risks that could potentially be involved, and for some people who just want to actually just talk to a human being and see this as just one more layer that they have to sort of get through in order to resolve some of their issues, because not everyone is comfortable with the technology.
It's a great point, and it's a completely opt-in. At any moment in time, you can always escalate to a live individual. So this is, if you feel comfortable, just as you start using like ChatGPT the first time, it may be a little more robotic. As you start using it, individuals get comfortable at different paces. So it's a completely opt-in model. At any point in time, you can always escalate to a live person. So it's really up to the consumer to decide how they want to interact with the brand. The key is they can interact with the brand across really any channel, whether it's on the website, it's on your mobile device, on a text message. That is up to the consumer's preferences, but they should be able to have a consistent experience no matter where they are.
Certainly interesting. I love to see this development of customer service. Obviously, a lot of people still pressing 0 on their phone and still want to speak to a person, but at least another option on the table for those that would perhaps prefer not to talk to somebody. So appreciate you joining us this morning. A big thank you there to AirKit.ai co-founder and CEO, Steve Heekian. Thank you so much.
Thank you, Rochelle.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What could higher rates mean for people's portfolios?
So higher rates, a couple of things. So if you're looking at your fixed income portfolio, obviously an ability to earn higher coupon, especially on very high quality parts of the market, earning close to 5% on something like 2-year treasuries, close to 6% on investment grade credit. I think that's an incredible opportunity for those savers. I think higher rates on your equity portfolio also has meaningful implications. So sort of navigating away from areas in the market that have historically been been expensive or been non-profitable that have relied upon negative real rates. So positive real rates is probably going to be more beneficial for areas that of the equity market that are more profitable to begin with. So looking at quality in a portfolio makes a lot of sense. And lastly, I would say that higher rates and how long rates stay high is going to be pretty meaningful for just the consumption backdrop. So how you and I spend our money.
Right.
So thinking about the ramifications of that on the economy, not today, but perhaps in a couple of quarters from now, and what that might do to growth, which of course will have ramifications on equities, fixed income, and commodities.
The price tag for college is quickly becoming one of the top concerns for undergraduates, especially with student loan payments set to resume. The Princeton Review's annual breakdown for best colleges gave the #1 spot for financial aid to Washington University in St. Louis and found the top 10 list this year awarded an average of more than $45,000 in need-based scholarships. Robert Franek, the Princeton Review editor-in-chief, joins me now to break all of this down. Thank you so much for joining us this morning. So talk about these colleges that made up that, especially that top list when it comes to financial aid. What are they doing right?
Yeah, Rochelle, I'm so grateful for the time, and it's such an important question to ask, because financial aid is on the minds of college-bound students, their parents, counselors helping them along the way, all that specter and nervousness around paying for college. We came up with this list based on student opinion. Students who are current college students answering questions about their satisfaction with their financial aid package. As you noted, Washington University of St. Louis, been on this list before, back in the #1 spot. But when you think about it, their sticker cost is a little over $83,000, but their average gift aid, this is money that students don't have to pay back, this is grant aid, is a little over $58,000. So bringing the out-of-pocket cost on average for most students at WashU to about $25,000.
And how are some of these colleges able to provide so much financial aid versus, I mean, some of the names that you see at the top here aren't necessarily Ivy League schools or schools that everyone, that are internationally known. How are they able to do this?
Yeah, it's an important question to ask. And there's simply differences in the financial wherewithal for schools. You're right. Big brand name schools, Ivies and near Ivies might be top of mind for students and parents. But some of them certainly will have great financial wherewithal, but it doesn't preclude all of these other schools, nearly 3,000 of them in the States alone, from having deep pockets from a financial aid perspective. The difference with these schools on the list is that they are channeling those dollars specifically towards financial aid for students. So what I tell all of my students at Princeton Review is never think about sticker costs. Don't have that shock that so many people, just being human, will have when they face a sticker cost of $84,000 or more, but focus on how much money you're actually getting when it comes to out-of-pocket costs, because schools can be very aggressive about offsetting that sticker cost with something that might be more palatable for students and parents across the planet.
And what about some of the schools that are the worst when it comes to financial aid, or the stingiest, shall we say?
Yeah, well, there are certainly schools that are better than not around financial aid. There are some usual suspects that we just want students to focus on and to focus on specific data points from those schools. What is the average gift aid, not only for a first-year student, but that you can count on for your 4 years at college or university? Those are the things that we focus on, as well as how much indebtedness are students actually graduating with. Now, students and parents might be surprised at this, but about $30,000 is the average indebtedness that most students will graduate with, and that number is just from May of 2023. Some students and parents might assume that it's much loftier because we talk about this stuff all the time, students that have ballooning debt. The most crushing of those stories, students that have ballooning debt but didn't actually graduate from college or university. Those are some of the points I would suggest taking a peek at.
And as we look at some of the issues that came up in terms of the most important answers to the survey, academics, of course, makes sense, 97%. Financial aid, though, coming in at 72%, and then followed by career services. So talk about some of the top 3 concerns people have, and as they're trying to weigh them, especially things like career services, what sort of return on investment do you get for a school that really does thrive when it comes to things like career services?
We talk about fit often at Princeton Review, and we talk about it in 4 different categories. Certainly, as you pointed out, an academic fit. We want to make sure that students are challenged and engaged in the classroom. Number 2, campus culture. Are you going to be happy not only academically, but outside the classroom as well? Number 3 is financially, of course, as you had noted, but number 4, career services. And I cannot understate this. If I overstate this enough. When we think about career services, and as you noted, what is going to be the return on your academic investment if you're a student, as well as your financial investment if you're a student in a family? I visit more college campuses than I'm convinced any other person on the planet. But if I'm not hearing in the first 4 or 5 minutes that I'm on a college campus about the career service or career development office, how it's affecting not only a senior, but a first-year student through their senior year, then I'm suspect. And those are things that students should be thinking about now, along with their parents and their counselors as well. What are students doing by way of internships and cooperative experiences and experiential learning? And the nomenclature, as you know, changes from school to school, but it all means the same thing. What are students doing outside the classroom to complement what they're learning inside the classroom? And is that lofting them on to a career of substance upon graduation?
And obviously, we've been through a lot, and college students have been through a lot because of COVID. How much has the list changed pre-COVID versus post-COVID, when now they have even more options for funding, whether it's private or public or other kinds of financial aid?
Yeah, well, I'm so glad you brought up the question. Some things have stayed eerily similar, right? Just thinking about the big bucket number, the $174 billion that is available for aid. That ratcheted up during COVID, and it's now leveled off to a pre-pandemic number, about $74 billion. About $174 billion. About $74 billion of that comes directly from grant aid, directly from schools. So to your point, when we start thinking about the money that most students are going to use for college, The first bucket of spending will be those dollars that the school is giving them, not by way of loans, but by way of grants, money that students don't have to pay back. And there are basically two factors that are triggering those dollars, right? It's how well a student does academically at school, the rigor of your courses, but then tying that, even in our post-COVID world, with SAT and ACT scores, thinking about that test optional movement and students still submitting those test scores to qualify not only for academic admission, but scholarship dollars as well.
And so for the parents out there or the prospective students out there, when they're trying to figure out their school, what would you say is the top tip when really trying to figure out the finances when you obviously you have your potential dream career and then the sticker shock just sort of, it sinks into your heart. It's like, I can't possibly afford this. What would be your top tip for them?
Top tip is number one, when you're thinking about schools, never, never, never cross an expensive school off of your list, particularly early on in the process. But then the second step is you must dig down into the homework. And this is stuff that I'm very proud that we do at Princeton Review. How much is that school aggressively offsetting that sticker cost to make it affordable for the average student and parent? And that's the difference that I think that most students and parents are going to be surprised at and delighted at many schools. So be fearless in looking at schools and then figuring out those dollars on what the average student would get by way of financial aid.
See, I have a 10-year-old, but I'm planning ahead. So this is all very helpful, I'm sure, for students and parents alike. A big thank you for joining us this morning. Robert Franick there, the Princeton Review Editor-in-Chief. Thank you for your time today.
Thank you.
All right, taking a look at Coinbase stock moving higher today after the country's largest crypto exchange announced that it received regulatory approval to offer U.S. retail customers regulated crypto futures in the coming months. Joining us now with more on this is Yahoo finance reporter David Hollerith. Hey, David.
Hey, Rochelle. So at the very least, this should be taken as a small win for the exchange. It's waited about 2 years to get approval from the National Futures Association, which is the regulatory body that's sort of assigned to issue these licenses by the CFTC. Now, the CBOE and the CME both already offer spot crypto and futures trading, but this is a first for a crypto native company to be offering both spot and futures trading to retail customers. Now, when that happens, we don't have a clear launch date yet. The company says that it's going to give customers more information about how to sign up for these futures products in the coming months. But the context here, obviously, is that for most of the summer, Coinbase's biggest story has been its court case with the SEC. The SEC is alleging that some of the crypto assets it offers are securities, and Coinbase disagrees, most recently saying that what they offer is more like the crypto assets are more like baseball cards. Now, so since that's obviously put at least a sentiment kind of dent in terms of where the future of Coinbase and crypto trading in the US will sit, seeing an offering like this, or at least the approval for an offering to the platform is obviously an optimistic win. Now, that being said, what are crypto futures? There's crypto derivatives, which, according to Coinbase, by their management or by their measurement, accounts for roughly 75% of total crypto trading volume in the crypto market. Crypto derivatives kind of come in a few different buckets. There's perpetual futures, and then also options contracts. Coinbase isn't offering those. They're offering US regulated futures, which you can think of maybe as just traditional futures. But they do offer some ability for investors to take some sort of hedging on their portfolios. They can go long or short on an asset. And from a market structure perspective, this, offers the crypto market as a whole in the US a little bit more depth and ideally, some lower volatility, although it's been quite low this summer. So this is kind of a small win. We're not sure exactly how it will fit or affect Coinbase's bottom line, but we'll definitely be paying attention to that. Recently, the company has sort of said that they want to put less emphasis on trading as opposed to some of the other crypto activities they offer. But we'll be waiting to see more about what the deal is here in terms of how this fits into their larger business strategy, and obviously what regulatory approval looks like just for simple crypto spot trading for a few of the crypto assets the SEC is alleged are securities.
And David, just very quickly, because we're seeing a lot of crypto under pressure here, Bitcoin again dipping below that 30,000 mark. Why aren't we seeing that same sort of enthusiasm there based on what the news that we're hearing out of Coin?
Yeah, I mean, I think one example is that crypto futures are already offered. So this isn't necessarily a big regulatory win that the industry kind of needs right now in the U.S. I would say otherwise, if you look at the broader market, it's a pretty unclear week, or at least past couple of weeks. And, we're going to be wanting to see more about these ETF offerings in terms of what's going to happen with the U.S. market. That'll probably come in September.
Indeed. We appreciate that update. Our very own David Hollerith. Thank you so much. All right, well, let's get you a final check of the markets as we head into the noon hour. Looking at a mixed picture here. The Dow, the only one in the green, as we can see there ever so slightly, though, up 47 points. The S&P 500 still under a little bit of pressure, though, down about 3 points. The Nasdaq also down about 0.45% as we really await those Fed minutes coming up at 2 p.m. Eastern later on this afternoon. Well, that does it for now. I'm Rochelle Akufa. I'll be back with you at 11 a.m. Eastern. And of course, we'll be back with you throughout the day on Yahoo Finance. We'll see you then.